pushed on the dual mandate. He said, listen, this is the thing that keeps me awake at night. The number one thing that keeps me awake at night is that overshooting, the over-tightening. So that is in there, and that is what opens the door a crack, not wide open, which is what we expected for September. And I do think they're going to move in September, and I agree wholeheartedly with Rich on this. I think the other issue is there's sort of this tale of two economies we're seeing emerge out there. The one that's in the household survey that's close to but not yet triggered the SOM rule, which is what got Bill Dudley up in arms, and how weak employment has been in the household survey, and the establishment survey, the GDP data, other jobs data that suggests the economy is still on solid footing. And right now the Fed has been opting into more of that establishment survey where payrolls have held up, although they're not quite as strong as they've been. We're going to get probably some good public sector hiring in the jobs numbers on Friday again, which will help buoy those overall numbers, adding to some weakness in the private sector. But I think that's important, is that the Fed is looking at this and they're weighing which is the right stuff, and really getting to Rich's point too. There isn't just one piece of data that the market keeps looking for that could tip the apple cart. The Fed is looking at the totality of the data, and that last line really gets to that point. The totality of the data will allow them to go in September, and they don't want to make the same mistake the ECB made, move and then have to freeze and be in a purgatory. Their credibility is at stake. They want to make sure inflation is coming down, but I agree with Rich, they'll still cut before inflation reaches its 2% target, anticipating that the economy, by lifting off that restriction, the economy will get there.
We have Swank and Clarida with us. Bob Michael, maybe a question for you on the economics of the moment. Are we slaves to measured? We have measured for decades. We're being very measured where maybe other central banks aren't. Are we just so afraid to move, and we're over careful, over cautious, because once we move, we've got to move in a measured vector?
I feel like we're back to the Greenspan Fed, where every word is so carefully thought out. It makes you want to overanalyze it, and no one can give an inch. If the wrong word is in there, then the FOMC gets concerned about the market pricing in hundreds of basis points of rate cuts and risk assets being up tens of percent.
Okay, please go ahead.
But we're talking about, and Rich touched on it, we're in, I think, very restrictive range. 25 basis points, you're not in a loose monetary world with money flooding all over the place. You're still restrictive. You've got to start that journey somewhere.
This is too important. Lawrence Meyer, Washington University, his monograph, A Term at the Fed. He tore Greenspan apart, that it was a dictatorship. Are we getting to the point now no one can dissent and everyone's measured because we're measured and appropriate?
No, I think no one has dissented because 2 years ago inflation was too damn high and they were all agreed they wanted to get it lower. It'll get more interesting as we get close. But what I want to say, to invoke the Olympics now, this is a Fed that really wants to stick the landing. They won't say this word, but their projection and what we're seeing in Bloomberg consensus and elsewhere is a soft landing, and they want to stick it. And the data is now solid, is moving in the right direction. And so, getting back to the Greenspan Fed, there was a soft landing or so in those years. Alan Blinder has written, they're not common, but we do see them. I think in 2019, I think the Powell Fed got a soft landing. We don't see it in the data because we got the pandemic. The economy looked pretty good in January of 2020. So they're trying to stick the soft landing.
Forget about sticking the landing. Let's just throw them in the Seine. The water's fine. We'll be okay.
You win. Better analogy.
Right.
Okay.
There's another analogy. Matt Hornback puts this out earlier, and I'd love your thoughts on this, Diane. Basically, the Olympic motto, to carry on with this, reads faster, higher, stronger together. Could have been used to talk about central banks globally altogether. Now, it might be more apropos, slower, lower, weaker together. Diane, how much is that looming over this Fed meeting? The idea not of synchronized swimming or synchronized rate cuts, but this idea of trying to sort of take an edge off for the rest of the world that really does seem to be dealing a little bit more with some negative growth.
I don't think that's the Fed's main concern, and I'm sure Rich will back me up on that. I remember seeing Ben Bernanke actually go after another central banker who said, you guys need to change your policy to help us out. And he said, that's not our problem, basically, at a Jackson Hole meeting. So that is not the Fed's primary concern. That said, a strong dollar helps us out down the road in keeping goods prices lower, so that helps the Fed out. I think what's more important here in terms of the Olympic analogies is that the road to gold is often paved with tears and obstacles. And I think people forget that, and I'm thinking of Simone Biles here, I'm sorry, she's my hero and heroine at this point in time. But I'm thinking about, soft landings. People forget that the 1994-95 situation, it looks great on paper. I lived it. I remember it. Rich, you lived it too. It was ugly at the time. Chairman Greenspan's reappointment as his third term as Fed chair was held up for 4 months in 1996 because he nearly crashed the economy in 1995, and people were so angry at him for not easing sooner. And it was his own colleagues, including Janet Yellen on the Fed, that got him to experiment with productivity growth and intense foreign competition, that bringing down inflation and allowing the unemployment rate to fall instead of using monetary policy to do it. That is really important to remember, is that soft landings are not easy. They look good on paper, but getting there can be a hard path.
Diane, where does the confidence come? Where does it come from that unemployment stabilizes at these levels and doesn't carry on shifting higher into year end? What underpins that?
Well, I think, I don't know if unemployment is going to stay there or not. It often moves up slowly and then moves up rapidly. All I know is that even Claudia Sahm, who wants the Fed to cut right now, has argued her own rule might not be applicable in the post-pandemic economy because of all the changes we've seen. We've seen much of the rise in unemployment has come from more people seeking jobs, an increase in the participation rate, particularly among prime-age workers. We've seen an influx of foreign workers, foreign-born workers, accounting for over 70% of the growth in the civilian labor force since February of 2020. That's helped to buoy the unemployment rate as opposed to a surge in layoffs. That doesn't mean there aren't stresses in the labor market. That doesn't mean there aren't still problems. But at the end of the day, what is it that people complain most about? They can complain most about the high level of prices still. And that's something that the Fed also has to keep in front of its mind. And I think that's where we're at. At the end of the day, we don't want to lose this and not hit that soft landing, but it's a rocky road to get there. I think we're still going to make it, given the fact that we saw the positive of consumers pushed back in the second quarter on price hikes, and retailers and producers capitulated. They rolled back prices on goods, and we saw a rebound in growth, doubling the pace of the first quarter, driven in large part by a rebound in consumer spending. That's the Goldilocks scenario towards a soft landing.
There's this issue, Bob. We're looking at market pricing, and right now it seems like this is consensus, that they are going to land the soft landing, even though it is sort of a rarity or a white elephant. Do you think that the market has overpriced that soft landing or even underpriced it because the internal skepticism just keeps on roaring?
No, I think the markets are right on track with the soft landing. And if it in fact happens, the Fed can bring down rates a fair amount, and the markets will continue to appreciate. I think what's different this time is the Fed and investors have a lot more real-time information. I was around in 94, 95. I was around in 81. And you didn't have that information. And now you have it. It's real time, it's live, you can see what's going on. Businesses have it, households have it. And maybe it gives policymakers a false sense of comfort, but they have that sense of comfort.
Which really kind of leaves the market kind of in the way, sort of in the same boat that the Fed is in. And I wonder, Rich, if you were still on the Fed, how much the Fed looks at the market to kind of gauge progress, sort of follows them, if you will, because they are gauging real-time data. And if anything, this is the collective will. And I love the war stories from the mid-1950s from everybody. But I wonder if, if that's something that they could really kind of sink their teeth into.
Oh, sure. Well, I mean, I'll just speak for myself, but you're looking at the market, hopefully to try to extract signal. There's always noise. You have to be honest with yourself. But it's particularly relevant for things like the growth outlook and the inflation outlook. You need to know what is being expected. That's a key input to monetary policy, our expectations. I gave one of my speeches at the Fed was on this point of avoiding the hall of mirror problems by looking at market prices. So I'm not saying it's easy, but I don't think there's an alternative.
I want to cross back over to Diane. Diane, I know you've got to go in a second. Just a quick final word. A question for Chairman Powell in this news conference, Diane, what would it be?
Well, this is on communications. I think it's going to be very hard for the Fed to communicate. We're already seeing financial markets are trying to front-run the Fed on a larger cut in September. Yeah. How do they calibrate their communications to deal with what may be more measured cuts?
Interesting. Diane, thank you. As always, Diane Swank there of KPMG. If you are just joining us, welcome to the program. The Fed decision came out about 20 minutes ago, unchanged on interest rates, and the statement largely unchanged as well, just some incremental changes. So the focus on the news conference now, which starts in about 10 minutes' time. With us, joining us now, I'm pleased to say, is Mike Gapin of Bank of America. Michael, going into this news conference, very incremental changes in that statement. Were you expecting more?
So in 10 minutes' time now at the bottom of the hour, do you expect the start of the FOMC press conference with Chair Powell? The live video to which is available on the feed or pinned to the calendar for anybody interested.
Exactly where they did, reflected a little bit in cooling labor market conditions, reflect a little bit more progress on inflation, kind of pin down and nail down that balance of risks argument, because that's what the chair had said in front of Congress. So I think this was the right incremental move. I think the Fed feels that it's in a sweet spot right now, that the data is moving in its direction, so it's getting closer. It just needs a little bit more, and then that confidence, that nebulous confidence, may be there. So this is what we were expecting. We weren't expecting a big lean in either direction from the statement.
The market, as you know, Mike, has been looking for September and a baby step towards that. You and the team have been looking for December. What separates you at the moment, Michael, the data that backs up your view, what separates you from the rest of the street at the moment?
Well, I'd say we have less concern about downside risk to the economy. We certainly are watching for it and looking out for that we may be wrong on this view. But the economy grew at a pretty solid pace in the second quarter. And yes, things are moderating and cooling, but I still think that there's a lot of resilience to both the economy and labor markets, and we'll see. Maybe there's a little unevenness in this inflation story. But certainly a September cut has moved a lot closer to our baseline. So yeah, we're still in December, but we've got 2 employment reports and 2 inflation reports between now and then. Further progress in those 2 variables, a little bit weaker employment, kind of repeats of what we just saw in June inflation, that could easily put a cut on the table in September. So September can happen, but it may not. So I think that's how I'd frame it right now.
Michael, let's just put a bow on this. What does further progress look like to you in the 2 labor market reports and the 2 inflation reads that we get until the next meeting?
Well, I think the labor market report is maybe a little more asymmetric. A strong report is probably not going to prevent them from cutting, but obviously a weak one could. So if they feel the labor market is softening more than they expect, they could go in that regard. Otherwise, I think to your earlier question of what's going to cause inflation to rise, I can't see it. I agree, but I don't think what they can rule out right now is that inflation settles in at a level that feels a little uncomfortable for them. So I think on the margin, a little more evidence that no, we're not going to get stuck with, say, core PCE in the high 2s. It does look like it's moving lower. So 1 or 2 more reports that give them confidence about that, then I think is probably enough.
Speaking of discomfort, we know a topic they're uncomfortable with, and that's politics. And if it comes up in this news conference, we know what Chairman Powell's going to do. He's going to ignore it. But there was a letter sent to him by Senator Warren and company. And TK, there's a quote in this letter. The immediate press release read as follows: "The failure to cut rates would indicate that the Fed is giving in to bullying and is putting political considerations ahead of its dual mandate to promote maximum employment and stable prices." So you've got the Republicans saying if you cut rates, it's political. And you've got the Democrats saying if you don't cut rates, it's political. Sort of stuck in a rock and a hard place between the both.
And what's important here, John, it's so important, is that Richard Claret is one of the people that bought history back to economics with his work at Columbia. I sat at the Fed with you in that magnificent library of first editions, and Elizabeth Warren reached down and said, take the book off the shelf. And I took Torsten Veblen, The Theory of the Leisure Class, off the shelf, and you and I were talking about it. This is a few years back. That's what Senator Warren's talking about, is the Gilded Age. Are we in a Gilded Age where the elites are talking only to the fancy people and indirectly doing monetary policy only for the fancy people?
Well, no, and in one word, I think, you know, the Fed has the dual mandate. Inflation was too high. They're focused on both sides. I think the economy's in a place where it can certainly adjust and wait another 2 months until the cuts commence. So I would push back on that.
Mike Gapen, would you push back? Just how relevant is the U.S. election and U.S. politics?
Well, the way I would frame this, and I think Rich would agree, I was formerly on staff at the board, and I learned quickly that no matter what you do or don't do, somebody's going to be upset, and one side will complain or the other will complain. So I think you learn quickly the best thing to do is to do what you think is right. So I would put it at that. So they have competing opinions here. The right thing to do is to do what they feels right.
Mike, I'll finish with the same question I finished with Diane Swong. Questions for the chairman. If Michael McKee's
5 minutes away now to the bottom of the hour, where we expect the start of the FOMC press conference with Chair Powell.
Well, the
Live
chair
video
said
pinned
that
to the
they can use
calendar
if
and
there's
on the feed for anybody
unexpected
interested.
weakness in the labor market, which is actual data that comes in below their expectation. But what about preemptive easing on the risk of labor market weakening? I think that might get at the gap between market pricing and what the Fed thinks it will deliver.
Mike Gapen, thank you, sir. Michael Gapen there of Bank of America. The news conference about 5 minutes away. Bob, there is a question here about what kind of interest rate cut it would be when we get one, if we get one in September. Is it a risk management decision? Is it a mid-cycle adjustment, the beginning of something much bigger than that? Do you think they have to frame it at this point? Do you think they have to characterize what it might be?
I think they do, and I think they'd like it to be part of the normalization process, that they've achieved their targets on both sides of their dual mandate, and they could start to bring down what is a restrictive policy.
Michael Gapen echoed your speech of January 2022. It's about ex-ante aspiration. I don't want you to voice for the chairman. I know that's inappropriate. But how does he voice the aspiration of getting out front here in 6-7 minutes?
Well, I think he'll stick to the mandate, and he'll stick to documenting the progress. And again, he won't use the word soft landing, although that's, I think, what they're trying to achieve. And I think Governor Waller's done a very effective job in his many speeches in making the point that they have time because the data is holding up quite well. You know, it was a very bold call a couple of years ago for Waller to say we can disinflate without this huge pain in the labor market. I think they were prepared to take it if it was required. It hasn't happened. And so now I think they're even more focused on the soft landing. And I do think they do want to avoid a premature declaration of mission accomplished, because even if underlying inflation is going to target, there's always noise in the data, and 2 or 3 months of noise on the wrong side is a bit uncomfortable.
Rich, there's this feeling baked into markets that Fed Chair Jay Powell is much more dovish than the statement might suggest. Are you expecting that tone to kind of come out in the news conference?
Interesting. You know, we heard a lot from Chair Powell at Centra on Capitol Hill, sitting down at the Economic Club of D.C. I've gone through and looked at that. I would actually expect him to stick pretty close to that, which was very balanced, not declaring victory, but acknowledging progress, emphasizing, as the statement does today, that they are really attuned and attentive to both sides of the dual mandate. You know, so there are some times where I think the press conference is really the chair using a lot of, this is what I think. I think we'll hear a lot of this is what we think today. I think the committee's pretty tightly aligned on where they are.
Bob, what are you listening for today?
I actually think he will come out a bit more dovish. I think that's the way he's rolled the last several meetings. He's surprised us by deviating from the script and indicating that, yeah, you know, he could see rate cuts on the horizon. I can't take my eyes off of the last sentence in the second paragraph, where the committee is attentive to the risk of both sides of its dual mandate. I got what I wanted, at least, which is acknowledgement of risks in the labor market. The more I look at that, the more it's clear to me that they're going in September. If I were Mike McKee, a lot of people tried to press the Fed on what their neutral long-term rate is. I would ask him, at what level is the Fed funds rate no longer restrictive?
Do you think they can answer that, Rich?
Well, I think they won't answer that. I think they have and this is one where there are probably 19 different opinions on the committee. One thing I'll say.
So we're shortly expecting the start of the FOMC press conference with Chair Powell. As a reminder of the order of business here, Powell would normally start by repeating the rate statement, which we've already posted on the feed, and the headlines for which are there as well, before taking questions at the event, which is where the headlines will come from. So we'll keep our eyes out for any important comments from Powell during this press conference.
I'm pleased you brought up Sintra, Portugal, because I think it's really important to reflect on the comments from Chairman Powell back in Sintra, Portugal at the ECB's annual get-together. Chairman Powell was talking about the strength of the labour market, and the strength of the labour market being a reason for them to wait, that they have time. They can wait and see. A few more months of data maybe. And it's his characterisation again in this news conference of the labour market that I think matters, off the back of that incremental change in the statement that you're all picking up on around the table, that last line of the second paragraph. You've seen this incrementally in the Fed speeches over the last few weeks, Lisa, the last month. They're placing greater emphasis on the other side of the mandate in a way that it wasn't even part of the conversation a year or so ago. Think about where we've come from. 2 years ago, Jackson Hole, August 2022, pain to get inflation down. The focus was
Fed's Powell taking the podium at the press conference now.
The focus shifting to the labour market. Let's take a listen to the chairman of the Federal Reserve, Chairman Jay Powell.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable
Fed's Powell
progress
says we've made
toward
considerable
both
progress on both goals in the past 2 years.
The labor market
has come into better balance.
The unemployment rate remains low. Inflation has eased substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce
we are maintaining our restrictive stance.
We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. We are attentive to risks on both sides of our dual mandate, and I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP growth moderated to 2.1% in the first half of the year, down from 3.1% last year. Private domestic final purchases, or PDFP, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal of underlying demand, grew at a 2.6% pace over that same period.
Powell says the growth of consumer spending remains solid but has slowed.
Last year's robust pace, but remains solid. Investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment stalled in the second quarter after a strong rise.
Powell says in the housing sector, investment stalled in Q2.
Conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 177,000 jobs per month in the second quarter, a solid pace, but below that seen in the first quarter. The unemployment rate has moved up, but remains low at 4.1%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years, and a strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market have returned to about where they stood.
So Powell says that data suggests that the labor market has returned to where it was on the eve of the pandemic. Broad set of labor market indicators show it's strong but not overheated, and inflation remains somewhat above the 2% goal.
Of 2%. Total PCE prices rose 2.5% over the 12 months ending in June. Excluding the volatile food and energy categories,
Powell says longer-term inflation expectations appear well anchored.
Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people.
So your stocks add slightly to gains as Powell's press begins.
Today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We have stated that we do not expect
Powell says need greater confidence on inflation
range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%.
Adds Q2 inflation readings have added to our confidence.
And more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate,
Powell says we will carefully assess incoming data for future decisions.
The evolving outlook and the balance of risks. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly,
Powell says policy is well positioned.
More quickly than anticipated, we are prepared to respond.
Powell says policy is well positioned again, but they are prepared to respond.
Uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the longer run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability.
Powell says reducing rates too late could unduly weaken the economy, as he now moves on to questions.
Gina Smilik from the New York Times. Thanks for taking our questions. Markets pretty much entirely expect a rate cut in September at this stage. I wonder if you think that's a reasonable expectation, and if so, why not just make the move today?
Thank you. So,
Powell, when asked about September rate cuts, says we have made no decisions for future meetings.
No decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the
Powell says the broad sense on the FOMC is that we're moving closer, however.
In that we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving
Powell says the question will be if the totality of the data is consistent with rising confidence on inflation and jobs.
Maintaining a solid labor market.
Says a reduction could be on the table in September.
Our policy rate could be on the table as soon as the next meeting in September. So you asked why not today, and I would just say again that the broad sense of the committee is that we're getting closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet.
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So I guess I would think about it this way. I'll give an example of cases in which it would be appropriate to cut and maybe that it wouldn't be appropriate to cut. So if we were to see, for example, inflation moving down quickly or more or less in line with expectations. Growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate
Powell,
cut
asked
could
about
be on the
September cut
table
again,
at the
says if
September
inflation
meeting.
moves down in line with
If
expectation and
inflation
growth
were to
remains
prove,
reasonably strong,
stickier
the labour
and
market
we
remains
see
as it
higher
is,
readings
a
for
cut in
inflation
September would be on the
disappointing
table.
readings, we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be the inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that help us make this decision.
And just to follow up on that, specifically, in what ways right now, given all you've seen over the last few months in particular on shelter, on services, et cetera, in what ways are you not confident right now that inflation is on the way back to 2%?
I think it's just a question of seeing more good data. We have seen the last couple of readings have certainly added to confidence, and we've seen progress across all three categories of core PCE inflation. That's goods, non-housing services, and housing services. So it's really just, we had a quarter of poor inflation data at the beginning of the year. Then we saw some more good inflation data. We had 7 months at the end of last year. We just want to see more and gain confidence. And as I said, we did gain confidence, and more good data would cause us to gain more confidence.
Thank you. Colby Smith with the Financial Times. The March SEP pointed to 3 cuts in 2024 with core inflation at 2.6% and the unemployment rate at 4%. Since we're now at that level in terms of inflation and already beyond what was projected for the labor market, I'm just wondering if that rate path is back to being the best guidepost for policy rather than, let's say, the shallower one laid out in the June SEP.
So I would just say really the path ahead is going to depend on the way the economy evolves. And I can't really give you any better forward guidance on it than that. We didn't, of course, do an SEP at this meeting. We will do another one at
so
the
the dollar's
September meeting.
weakening here, just pairing some of these gains, negative down spot 3% according to the Dixie now. As Powell makes some more dovish comments, again saying there's a broad sense on the FOMC that they're moving closer and that a rate cut could be on the table in September. Powell does say, however, I can imagine a scenario of 0 cuts to several cuts this year, depending on how the economy evolves.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said before that you wouldn't wait until inflation got to 2% to cut rates because of how inflation has lagged. Does that apply for the labor market too? If the labor market is back in equilibrium, why is restrictive policy and potentially very restrictive policy, given the high real funds rate, warranted right now?
So this is the very reason that we're thinking about that we've said in our statement that we're going back to looking at both mandates and that we think the risks are coming back into balance. We think what the data broadly show in the labor market is an ongoing gradual normalization of labor market conditions, and that's what we want to see. We've seen that over a period of a couple of years, and a move really from overheated conditions to more normal conditions. We are watching the labor market conditions quite closely, and that's what we're seeing. If we start to see something that looks to be more than that, then we're well positioned to respond. That's part of what we're thinking.
And when you talk about seeing something that's more than whatever softness or slowdown you expect, in the past you've said that stronger growth wouldn't override better news on inflation. I wonder how that cuts the other way. If you're seeing more softness in the labor market than what you would expect, does that change the calculus on what you're looking for out of the inflation numbers to recalibrate policy?
So we have growth isn't one of our three. We have 2 mandates, as you know. The labor market, maximum employment is one, and stable prices is another. So we weigh those 2 things equally under the law. When we were far away from our inflation mandate, we had to focus on that. Now we're back to a closer to even focus. So we'll be looking at labor market conditions and asking whether we're getting what we're seeing. And as I said, we're prepared to respond if we see it that it's not what we wanted to see, which was a gradual normalization of conditions. If we see more than that, and it wouldn't be any one statistic, although of course the unemployment rate is generally thought to be a good single statistic, but we'd be looking at wages, we'd be looking at participation, we'd be looking at all the things, surveys, quits, hires, all of those things to determine the overall status of the labor market. But we're looking at it now. I would say, again, I think you're back to conditions that are close to 2019 conditions, and that was not an inflationary economy. Broadly similar labor markets then. I think inflation was actually, core inflation was actually running below 2%. So I don't now think of the labor market in its current state as a likely source of.
Powell says we don't think of the labor market as it is as a current source of inflation pressures.
Material further cooling in the labor market, and that's part of what's behind our thinking. The other part, of course, is that we have made real progress on inflation, and we've got growing confidence there that we are not quite there yet, but we're getting more confident that we're on a sustainable path down to 2%. So those two things are working together, and we're factoring those both into our policy.
Chris Rugaber at Associated Press. You mentioned not wanting to see any further cooling in the job market. Why not, or would you consider preemptive cuts to prevent if you saw risks of an unexpected cooling? Is that something you would cut ahead of time for?
So I wouldn't say I wouldn't want to see any other cooling. It would be more of a material difference. If we'd be looking at this, and if we see something that looks
Powell says if we see something that looks like a significant downturn in the labor market, then we would respond.
We would have the intention of responding to. So in terms of, I don't think of it that way. I think of it as, we're actually in a good place here.
Powell says we are in a good place here, balancing risks.
Go too soon, and you undermine progress on inflation. Wait too long, or don't go fast enough, and you put at risk the recovery. And so we have to balance those two things. That's the nature of having two mandates, and I think this is how we balance them. It's a rough balance, but it does feel like, again, the labor market feels like it's in a place where it's just a process of ongoing normalization. 4.1% unemployment is still historically low, and we'll just have to see what the data show us.
And just to follow quickly, wanted to see what you thought of the recent JOLTS report, which did show gross hiring has come down even below 2019 levels. Layoffs remain low, so it painted a picture of a very static labor market. Is that sustainable in your view, or something that is worrying? Thank you.
So I think all of the data points continue to point to kind of the direction we would want to see. So that was taken as there was a decline in job openings. That was good. Today's
Powell says all the data continues to point in a direction we want to see.
Softer than expected, so that's a good reading. It shows that wage increases are still at a strong level, but that level continues to come down to more sustainable levels over time. That's exactly the pattern that we want to be seeing. So I think the data we've been seeing in the labor market are broadly consistent with that normalization process. Again, we're closely monitoring to see whether it starts to show signs that it's more than that.
Steve Leisman, CNBC. Mr. Chairman, back in March, you talked about cutting rates as a process, and in June, you talked about the idea that, well, one rate cut wouldn't do anything. So I wonder if you can sort of follow up on Colby's question. Talk about, are you weighing the economy right now in terms of its ability to withstand multiple rate cuts? Talk us through the process that you're thinking, or is it just one rate cut, or are you in the process now thinking that rates need to be normalized here? Thank you.
Yeah, I can't really say that, honestly. We've seen significant movement in the labor market, and we're very mindful of this question of is it just normalization or is it more? We think it's just more normalization, but we want to be in a position to support the labor market. At the same time, we're seeing progress on inflation. So, we actually got to this. We raised rates a year ago at the July meeting, and if you look at the situation in the economy a year ago, inflation was over 4%. It was a completely different economy. Now we've made a lot of progress, and the labor market has, I think, unemployment was in the threes, mid-threes. So it's a different economy, and I think it's coming to be time to adjust that so that we support this continued process. The thing we're trying
Powell
to do
says it is coming to be time to adjust rates to support our continued progress.
We've had this really significant decline in inflation, and unemployment has remained low. And this is a really unusual and historically unusual and such a welcome outcome for the people we serve. What we're thinking about all the time is how do we keep this going? And this is part of that. We think we don't need to be 100% focused on inflation.
Powell says we don't need to be 100% focused on inflation.
Headline at 2.5, core at 2.6. You know, it's way down from where it was. The job is not done on inflation, but nonetheless, we can afford to begin to dial back the restriction in our policy rate. And I think we're just as part of a process. In terms of what that looks like, I mean, I think most rate...
Powell says the job is not done on inflation, but we can afford to begin to dial back the restriction on the policy rate. In a base case, you would think policy rates would move down from here. No guidance on the pace of cuts, as that depends on the economy, though.
The pace at which it might happen, because I think that's really going to depend on the economy, and that's highly uncertain.
Rachel. Hi, Chair Powell with Rachel Siegel from the Washington Post. Thanks for taking our questions. On inflation, do the past few months of good reports look like what we saw last year, where you really had a lot of momentum with a few bumps in between? Would you characterize that kind of momentum as back on track at this point in the year?
Actually, what we're seeing now is a little better than what we saw last year. Last year, as we pointed out late in the year, a whole lot of the progress we saw last year was from goods prices, which were going down at an unsustainable rate.
So Powell says we are now getting broader disinflation.
This is a broader disinflation.
What we're seeing, inflation is a little better than we saw last year, says it's broader.
We're also now seeing progress in the other two big categories, non-housing services and housing services. So, you know, so the thing is you got 1 quarter of that. We had 7 months of low inflation. You got 1 quarter of this. I would say the quality of this is higher. And it's good, but so far it's only a quarter.
Powell saying the quality of the current disinflation is higher, but it's only been a quarter of data.
You know, to have more confidence that we're on a good path down to 2%. But as I mentioned, our confidence is growing because we've been getting good data. Okay. And things like the ECI report and frankly the softening in the labor market conditions, you know, give you more confidence that the economy's not overheating. It doesn't look like an overheating economy. And it looks like an economy that's normalizing.
Okay. And if we were to think about the first couple of months of the year, is there any sense now that they were these blips that could have actually allowed for earlier rate cuts, as were some of the projections going into 2024?
So the thing about if what it is seasonality, and it could just be, it's very, very hard to, you know, to do appropriate seasonal adjustments. If that's what it is, then that actually implies that other months were reporting too low inflation. If you smooth it out, it's a zero-sum game. And that's why we look at 12 months. We look at 12 months because
S&P 500 extending gains on some slightly dovish Powell comments here.
2.5% headline, 2.6% core. This is so much better than where we were even a year ago. It's a lot better. Now, the job is not done. I want to stress that, and we're committed to getting inflation sustainably down to 2%, but we need to take note of that progress, and we need to weigh the risks to the labor market and the risks to our inflation target now more equally than we did a year ago.
Michael McKee from Bloomberg Radio and Television. I'd like to ask you about the balance of risks as the American people see it. At this point, is the risk greater to leave interest rates where they are, given the damage that higher interest rates do to the economy in slowing demand and raising prices? Or is it more important for the American people that you keep rates where they are to bring inflation down?
I think that we've been given an assignment by Congress. This is how we serve the American people, is by achieving maximum employment and price stability, right? And so in our, quasi-constitutional document, the Statement on Longer Run Goals and Monetary Policy Strategy, we look at the two goals, and if one of them is farther away than the other, the two variables, inflation and employment, if one is farther away from its goal than the other, then you concentrate on the one that's farther away, and you take account of the time to reach the goal. So for the last couple of years, the best service we could do to the American people was to focus on inflation. But as inflation has come down, and I think the upside risks to inflation have decreased as the labor market has cooled off, and labor market has softened, probably the inflation is probably a little farther from its target than is the employment, but I think the downside risks to
Powell says downside risks on the employment mandate are real now, and upside risks to inflation have decreased.
If you think about where that takes us, is we have a restrictive policy rate. It's clearly restrictive. It's been the rate we've had in place for a full year, and the time is coming, as other central banks around the world are facing the same question. The time is coming at which it will begin to be appropriate to dial back that level of restrictions so that we may address both mandates.
Well, you have event risk, basically, with the jobs report on Friday and another one before you meet again. Are you certain that you won't fall behind the curve and lead to unnecessary unemployment if you wait until September?
Certainty is not a word that we have in our business. We get a lot of data between now and September, and it isn't going to be one data read or even two. It's going to be the totality of the data, all of the data, and not just and then how is that affecting the outlook and how is it affecting the balance of risks? That's going to be the assessment that we do. Of course, we'll all look carefully at the employment report, but so much other data coming in, and so much happening between now and the September meeting, and we'll make a judgment.
Thank you, Mr. Chairman. Edward Lawrence of Fox Business. I do want to dig deeper on what Michael and what Nick were asking. There's a shift in the statement to balance between the focus between inflation and jobs. Looking at the job sides, we've seen wage data show sort of an abrupt slowing. We're hearing on earnings calls from companies like Intel abrupt layoffs. In the jobs report from the BLS, government jobs has been a leading creator. Could the government jobs as a sector hiring mask underlying weakness in the jobs report?
Well, we'll look at everything. We've seen some tendency to have a narrowing base of job creation in some months going back, but then we've had some months where job creation was broader, and also the headline number of jobs has come down. So but you look at the whole thing, and I think you do look at private demand extra carefully. To your point about government. So we'll just be looking at all those things.
So as a follow then, so could the Fed then be behind the curve? Because you said some of the reports, last meeting, you said the reports could be noisy or overstated. Was there a discussion of what kind of discussion was there for a cut today? And could the Fed be behind the curve?
Yeah, so look, the objective is to balance the two risks, right? It's the risk of going too soon and the risk of going too late. We've been, we had 7 months of good inflation data at the end of last year. We said we wanted to see more. We pointed out that too much of this was coming from goods, and sure enough, the first quarter wasn't great inflation data. Now we've got a quarter that is good, and we're balancing the risk of going too soon against the risk of going too late. That's what we're doing. There's no guarantee in this. It's a very difficult judgment call, but this is how we're making it. But in terms of today, your question about today, we did have we had a nice conversation about this issue today. The overall sense of the committee, as I mentioned, is that we're getting closer to the point at which it'll be appropriate to begin to dial back restriction, but we're not quite at that point yet. We want to see more good data.
Powell says all 19 participants supported the decision today.
But there was a real discussion back and forth.
Powell says there was a real discussion about the case for reducing rates at this meeting, though.
A strong majority supported not moving at this meeting. That was the strong sense of the committee. But it's a conversation that we had today, certainly.
Courtney. Courtney Brown from Axios. Thank you for taking our questions. When the Fed was raising rates, there was a lot of conversation about long and variable lags. I wonder if that applies on the way down too. How are you and the committee thinking about that?
Yes, it does. And I think the lags have kind of showed up here in the last 6 months, by the way. You really do now see the restriction, whereas, even a few months ago, people were questioning how restrictive policy was. Look at the labor market now. You can see. And look at inflation. Rate-sensitive, interest-sensitive spending. You really do see now that policy is restrictive. I wouldn't say it's extremely restrictive, but it's certainly effectively restrictive. Yes, the lag should be on the way down. It should take some time to get into the full economy, affect financial conditions, and that affects economic activity, hiring and that kind of thing and ultimately inflation. It's not instantaneous, although it's faster than it used to be because markets move now in anticipation of our moves.
So are you worried then that if monetary policy acts with long and variable lags, even when you're lowering interest rates, it might be too late for the Fed to help stave off any kind of slowdown in the labor market or broader economy?
Yeah, we have to worry about that. I mean, just to make it clear, it's a very difficult, challenging judgment, and we don't want to go too soon. We don't want to go too late. But this is how we've made that judgment. I feel good about where we are. We're certainly very well positioned to respond to weakness with the policy rate at 5.3%. We certainly have a lot of room to respond if we were to see weakness. That's not what we're seeing, though. What we're seeing, look at the first half growth numbers. Look at PDFP at 2.6% for the first half. It's not signaling a weak economy. It's also not signaling an overheating economy. Labor market, admittedly, the unemployment rate has moved up 0.7, and we're seeing a normalization there. But wage increases are still at a high level.
Interest rate futures prices rise after Fed Chair Powell speaks as trader adds to bets on Fed rate cuts.
They're pretty stable, and they're historically not high at all. So the total scope of the data suggests a normalizing labor market. And again, we are carefully watching to see that continues to be the case.
Victoria. Hi, Victoria Guido with Politico. On the labor market, I was wondering, how worried are you all about unemployment rising to the point where it triggers the SOM rule? And would that potentially affect how quickly you cut rates?
So I would just say the question really is one of, are we worried about a sharper downturn in the labor market? So, and the answer is we're watching really carefully for that. We're aware of that rule, which is really I would call it a statistical thing that has happened through history. A statistical regularity is what I'd call it. It's not like an economic rule where it's telling you something must happen. So, again, what do we see? What are our eyes telling us? We look at all the things we're seeing, and what it looks like is a normalizing labor market. Again, job creation at a pretty decent level, wages moving up at a strong level, but coming down gradually. Job vacancies have come down, but they're still high by historical standards. So, again, I've been through some of the data already, but what we think we're seeing is a normalizing labor market. And we're watching carefully to see if it turns out to be more. It starts to show signs that it's more than that, then we're well positioned to respond.
Is there reason to think that the labor market might behave differently this time than it has historically?
I think history doesn't repeat itself. It rhymes. I think that statement is very true about the economy. You never assume it's going to be just the same. An example would be, is there a trend increase in the level of vacancies? There are many, many examples, so it's never exactly the same. Also, let's remember that this pandemic era has been one in which so many, apparent rules have been flouted, like the inverted yield curve, for starters. So many pieces of received wisdom just haven't worked, and it's because the situation really is unusual or unique in that so much of this inflation came from the shutdown of the economy and the resulting supply problems in the face of, admittedly, very strong demand. So the whole situation is not the same as many of the other prior inflation or downturns that we've seen.
Seeing initial reports of an explosion heard in Baghdad, Iraq.
To be very careful about the judgments that we make, I would say. So we don't assume that these regularities will just repeat themselves automatically.
Thank you, Chair Powell. I'm Mara Mokwe with Bloomberg. There seems to be quite a difference between what the anecdotal data are telling us, such as the very recent downbeat beige book, and the hard data. Do you take those anecdotes seriously? That is, that the economy and labor market are cooling much more rapidly than what's shown in the data?
So I do take that seriously, and the beige book is great. What's even greater is hearing the Reserve Bank presidents come in and talk about their conversations with businesses and business leaders and workers and people in the nonprofit sector in their districts. But I'll tell you, it's a pretty, the picture is not one of a slowing or, a really bad economy. It's one of, there are spots of weakness, and there are regions where growth is stronger than other regions. But overall, it's, again, look at the aggregate data. Aggregate data is, particularly PDFP, private domestic final purchases, is 2.6%, and that's a good indicator of private demand. So we listen to all of that, and it does. I think it's important to listen to anecdotal data and not just look at the aggregate data. Especially, it's very hard. GDP data can be volatile quarter to quarter. So it's just hard to measure economic activity. There are it's just difficult to do. So I look at both, but I wouldn't say that the anecdotal data is uniformly downbeat. It's more mixed.
Thank you. Jolene Kent with CBS News. Chair Powell, thanks for taking our questions today. You have consistently said that the Fed does not consider politics in making decisions. With a possible September rate cut on the table, it would be less than 2 months before the election, and former President Trump reportedly said that cutting rates so close to the election is something the central bank knows they shouldn't be doing. What's your response, and do you believe it's possible to really remain apolitical with a September rate cut?
I absolutely do, and I think it's, first of all, we haven't made any decisions. I would say it this way. Haven't made any decision about any future meeting. I don't know what the data will reveal or how that will affect the appropriate path of our policy. I really don't know. I do know how we will make that assessment. That's what I do know. So if you take a step back, the current situation, again, is inflation has come down much closer to our goal, and that's happened while unemployment has remained low. We're very tightly focused on using our tools to try to foster that state of affairs continuing. That's at each of our meetings and all of our decisions, our focus is strictly on that and really on nothing else, doing our part, whatever that part may be. We're using our best thinking. We're doing our best to understand the economy. We follow academics. We follow the many commentators who bless us with their commentary, but we don't change anything in our approach to address other factors like the political calendar. Congress has, we believe, ordered us to conduct our business in a non-political way at all times, not just some of the time. I'll say this too. We never use our tools to support or oppose a political party, a politician, or any political outcome. The bottom line is, if we do our very best to do our part and we stick to our part, that will benefit all Americans. If we get it right, the economy will be stronger, we'll have price stability, people will find jobs, wages will rise in real terms, everyone will benefit. So that's what we believe, and that's how we will always act. This is my 4th presidential election at the Fed. I can tell you this is how we think about it. This is what we do. So anything that we do before, during, or after the election will be based on the data, the outlook, and the balance of risks, and not on anything else.
Just a quick follow-up. Do your economic forecasts and models take into account the 2 very different economic plans of these 2 presidential candidates, Harris and Trump? And if so, how?
No, we do not do that. We absolutely do not do that. We don't know who's going to win. We don't know what they're going to do. We don't act as though we know, and we just can't do that. We basically, we have our forecast. We can run simulations of different potential policies, but we would never try to make policy decisions based on the outcome of an election that hasn't happened yet. That would just be a line we would never cross. We're a non-political agency. We don't want to be involved in politics in any way, so we wouldn't do that.
Nicholas.
Thank you, Chair Powell. Nicholas Jasinski from Barron's Magazine. There hasn't been a dissenting vote on an interest rate decision in some time. If the data do evolve as you expect, if you do have more confidence by the September meeting, do you get the sense that there will be a unanimous vote on an interest rate move in September? Or basically, are there meaningful differences in committee members' assessments of how much more confidence is needed?
So there are always meaningful differences. There are, and we talk a lot before, during, and after the meeting. We do have a very robust discussion of these things. You're right that in most cases, people, if they feel heard and they feel that their position has been given serious consideration, for most people, most of the time, that's going to be enough. There are dissents. That's fine. No one has a veto. No single person has a veto. So it just is a question of who will vote for and against. We've had dissents. We haven't had so many during the pandemic era, and it just may be that we felt more united because we felt under a lot of pressure to get things right. But before the pandemic, we had plenty of dissents, and dissents happen. It's part of the process. There's nothing wrong with dissents, and if it happens, it happens.
Jean.
Hello, Jean Young with M&I Market News. Is a 50 basis point cut as a first cut at all likely or even on the table? Thank you.
I don't want to say.
So Powell asked about a 50 basis point cut, so that's not something we're thinking about right now.
Jennifer.
Of course, I haven't made any decisions at all as of today.
Thank you, Chair Bell. Jennifer Schonberger with Yahoo Finance. Not to get into the minutes, but you said there was a real discussion today for moving at this meeting. I'm curious if you could provide some more color on the nature of the discussion today at the meeting about a possible rate cut as early as September.
Well, so, the way the meeting is set up, the first day there's a discussion of financial stability because it's every other meeting we have that. And then we have an opportunity to comment on that. Then we have an economic go-around. And then this morning we have the monetary policy go-around. And I think in people's economic go-around and in their monetary policy go-around, people express their views about this. And there's a range of views. People, as you will know from the speeches that they give, people have different ways of thinking about the economy. And so in the minutes, we'll lay this out in a much better way than I can do off the cuff. But there's a range of perspectives, and but I do think that we're a consensus-driven organization. People come together. This was a unanimous decision, and at the end, everyone supported the outcome, not just the voters, but everyone. So I would also say some people examined the possibility, the case for moving at this meeting, but overwhelmingly the sense of the committee was not at this meeting, but as soon as the next meeting, depending on how the data come in.
But there is a growing sense of confidence that you could move at the next meeting, assuming inflation comes.
Well, assuming that the totality of the data supports such an outcome, no question. That is the case. That, as I mentioned, we think that the time it's approaching, and if we do get the data that we hope we get, then a reduction in our policy rate could be on the table at the September meeting.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Former New York President Bill Dudley wrote an op-ed in Bloomberg earlier this month, which you probably saw, in which he said, quote, "It might already be too late to fend off a recession by cutting rates. Dawdling now unnecessarily increases the risk." Is he wrong?
So this is the judgment that we have to make, and we're well aware of the judgment. We're as I've said, we have to weigh the risk of going too soon against the risk of going too late. If we go too soon, we can, we had a lot of advice, to go ahead and cut after the 7 good months of last year. We didn't. We said we needed to see more. Then we saw some higher inflation. We've seen 1 quarter of good inflation, and we've seen the labor market move quite a bit. And as I mentioned, I don't think it needs to, cool off any more for us to get the inflation results that are related to the labor market. Not all inflation is, of course. So I think it's a difficult judgment to make, and what you see is the judgment of the committee is that that time is drawing near. That time could be in September, if the data support that.
And have the chances of a hard landing increased?
So I don't know whether they've increased. I think they're low. I think this is, you don't see any reason to think that this economy is either overheating or sharply weakening. That's just not in the data right now. What's in the data right now is an economy that's growing at a solid pace, a labor market that has cooled off, but nonetheless, unemployment is low. You know, the data overall show a strong labor market, you know, so that's really what you see. It's neither an overheating economy nor is it a sharply weakening economy. It's kind of what you would want to see, but of course, the job is never done. You know, we're watching to see, you know, which way the economy heads, and I think if we are to respond to weakness, we're certainly, you know, well equipped to do that. But that's not what we're seeing. What we're seeing is strong economic activity and, you know, a good labor market and inflation coming down.
Greg.
Thank you so much. In the minutes of the June meeting that came out a few weeks ago, there was a discussion about communications, and some Fed officials said maybe the Fed wasn't as clear enough about its reaction function. And when I talk to the commentators who bless you with their comments, they say that they really don't have a sense of what is going to judge, maybe not the first cut, but the pace of the cuts going forward. They don't have a good sense of that. Is there anything you can say, like, how will we judge that?
Yeah, I mean, I think the reality is that forecasters, and this isn't just the Fed by any means, forecasters have been continually surprised by, for example, the strength of the economy last year. So I think we had to be pretty humble about giving forward guidance about this, that, and the other thing. We need to be pretty careful about that. And, you know, when you're saying you're going to be data-driven, of course, it's always what the data, how they affect the outlook and the balance of risks, but nobody has great vision deep into the future. In terms of a reaction function, that's a long time, you know, discussion that people have had forever. I think people have understood for a long time, actually, that we were very focused on bringing down inflation. Nobody was really confused about that. The data have, you know, again, you've seen significant improvement in inflation just for the last quarter. Markets move around on the data, really, not so much. It's not really what we're going to do. It's more just that the data keep coming in, and markets are very, very responsive to that data right now.
Go to Jeff for the last question.
Thank you, Mr. Chairman. I'm going to change gears on you just a little bit from all of the rate talk and whatnot. With Fed now being in the books for a little over a year, there hasn't been a whole lot of talk about central bank digital currency, and wondering if you could give us an update on where things are with that. Is that considered a dead issue now? Is it still something that's being discussed within the committee, and what's happening with that?
It's not something that comes up at all in the FOMC. So more broadly, digital finance is an area that has really significant implications for payments generally, instant payments, and it's something that's going to really change the way it's going to make more efficient and hopefully safer and all those things the way payments are made around the world. And so we have people who are researching that and trying to keep up to speed, because we play an important role in the payments sector, both as a convener and as an operator too. In terms of a CBDC, there's really nothing new going on. There's not much going on at all. We don't have the authority to issue a retail CBDC that's available to the public. We're not seeking that authority. So what we're doing is keeping up with developments there. Pretty much every major central bank in the world is at least doing that. Some of them are actually seriously looking at implementing a CBDC. We're really not. We're really just evaluating, the story and what's happening out there. I think it's work that we need to be doing, which could be very beneficial down the road, but we don't have.
So Fed Powell has now ended the press
we don't
conference.
Have any plan we would need to go to Congress, and we have no plan to do that. No one here has decided that we think it's a good idea yet. Thank you.
That wraps up the July Federal Reserve News Conference with Chairman Powell. If you are just tuning in, welcome to the programme. Let's wrap that up for you. This market got the dovishness it wanted to hear. The equity market's positive by close to 2% on the S&P 500. On the NASDAQ 100, up by 3.3. We're moving closer to cutting interest rates. September could well be on the table. Push that through the bond market, a fifth consecutive day of gains for the 10-year Treasury. Yields lower. We're down by 4 basis points on a 10-year. It's a break of 4.1%. So we've all got the same question, just how low is the bar for a rate cut in September? This is what the chairman had to say.
The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
So let's talk about the calendar. The next meeting, September 18th, the data in between. August 2nd, this coming Friday, payrolls. August 14th, a CPI report. September 6th, the jobs report. On the 11th, another CPI report going into a Federal Reserve decision week. And most people assuming after that, Lisa, we're like this far away from that interest rate cut.
Especially at a time where there was a different type of language in this communication. We are not data dependent. They are data dependent. They're not data point dependent. They want to draw a distinction that one data point isn't going to throw them off materially. They repeated the totality of the data as well as how they just need to see the same kind of good data that they've already been seeing.
The time continuum to me was critical. I thought Steve Leisman's question was great about measured. He alluded to this. They're slaves to measured, John. That's all there is to it. I just don't know what else to say. I'll talk to Dudley about it here. To have Clarida and Dudley with us today is
fantastic.
It's just lights out. And I really, for those of you at Global Wall Street, what's coming up here with Dr. Dudley is required listening.
There was a fantastic line that came from Evercore's Krishnagua. I want to share this quote with you. He thinks they've laid the foundations for a rate cut in September. I think a lot of people observing that news conference would agree. But this quote's interesting. We think in practice it's not very data point dependent and view the cautious evolution of the statement as intended
So as the presser ends, just noting the S&P 500 pairing some of these gains, still up some 2% on the session so far.
Signal a month from now at Jackson Hole. I'm thinking about the minutes as well. I just wonder how well set the stage is for the Doves to dance and sing very loudly in these minutes that come out in a number of weeks' time.
I was very happy that the reporter asked him to elaborate on the fact that at this particular meeting, they did discuss the possibility of cutting rates, that there were a few members, but not the vast majority. Here is the question. How loud was that voice, and what did they have to give to those people to get on board with them in terms of this decision?
As you bring in Dr. Dudley, moments ago, the 10-year yield broke down to a 408.92. It's a new low yield. Can you imagine, John, what our shows are going to be like with a 399 10-year? I can't get there.
Where are we going to be in September? Where's the unemployment rate going to be in September? That's the big question I have going into the payrolls report this Friday. Bill Dudley got a shout out in this news conference. Bill Dudley joins us now, the former New York Fed president and Bloomberg opinion columnist as well. Bill, I want to go to your column that you wrote in the last week or so. It was quoted in this news conference. I'm sure you heard it. What did you think of the chairman's response to it?
I thought it was a fair response. I mean, this is my opinion, and the Fed is reaching a slightly different opinion. I mean, we're at a point where the risks are pretty closely balanced, and so the question is, do you go a little earlier or do you go a little later? I think, the reason why I thought it made more sense to go is that if the market's already pricing in September with a high degree of certainty, what are you really waiting for at this point? Why take the additional risk of, the economy deteriorating further? So, at the end of the day, it's probably not going to make a lot of difference. But I think, given the fact that the market expects the Fed to cut, once that decision is mostly made, and I think you heard today it was mostly made, then why are you waiting?
Bill Dudley, your essay heard around the world, the single sentence, the Fed doesn't want to be fooled again. You've held court at Princeton, where the late, wonderful Daniel Kahneman held court. Here's Kahneman with Tversky. Decision makers know they are prone to regret, and the anticipation of that painful emotion plays a part in many decisions. How is regret aversion playing in to this massive data dependency ex post ballet?
Well, what may be happening here is the fact that they got fooled on inflation, early this year, where the data came in bad, makes them overly cautious that they're going to make this, that they could make the same mistake again by going early. I think it's,
So
economists talk
traders
about
see
recency
70 basis
bias. You
points of
put too
Fed
much
cuts
weight
this
on
year
the
now,
most
up from
recent
64 basis
experience.
points earlier.
So this may be a case where they're not putting enough weight on the fact that, things are slowing and the inflation's coming down, and maybe now's the time to act. I think it was interesting. You got a question about the SOM rule, that the fact when the unemployment rate climbs above 0.5% on a 3-month moving average basis, you always have recession. He said he is aware of it, but clearly the Fed doesn't put a lot of weight on that risk.
Do you feel like we're getting closer to the moment where we will see real dissent on a committee that's being cobbled together and you can kind of feel the strains in some of the communiques?
No, I think what happened today was basically the Doves got a pretty dovish statement and a pretty dovish press conference, and so they're sort of set on board, and the Hawks got more patience. And so when you arrive at the September meeting, assuming the outlook doesn't change in a material way, and that's basically what Paul was saying, it's not about a single data point. The outlook has to change in a fundamental way for the Fed not to go in September. At that point, you have something to basically give to both the Doves and the Hawks. The Doves, thank you for being patient. The Hawks, we waited, so let's go together unanimously at the September meeting. So I think it's a good possibility that you'll see a unanimous
And so
vote
seeing
in
it
September
cited
for a
on
25
X here,
basis
citing the
point
New York
rate
Times.
cut.
Apparently, 3 Iranian sources told the New York Times that Iran's leader has ordered a direct attack on Israel in response to the assassination.
The false positives we're getting from traditional indicators. Just to reflect back on that piece that you wrote for Bloomberg Opinion, can you walk us through why you do think actually the SOM rule does matter? That maybe we should have a little bit more of a focus on these traditional indicators still and not completely ignore them?
Well, if I can start with the yield curve, the reason why I don't think the yield curve is necessarily a good predictor is the yield curve isn't because people think monetary policy is tight. So it's not the yield curve shape that causes the economy to weaken. It's the presumption that monetary policy is restrictive that causes the economy to weaken. Most of the time when the yield curve is inverted, monetary policy is tight, and so the yield curve is a good predictor. The SOM rule, I think, is a little bit different. It's basically saying once the labor market deterioration goes beyond a certain point, it becomes self-reinforcing. Essentially what I think happens is households hear about the labor market weakening, they pull back on their consumer spending, that causes businesses to pull back in terms of investment and hiring, and that leads to further weakness in consumption and then further rises in the unemployment rate. It's a pretty amazing statistical regularity that either rises less than 0.5% or next stop is a full-blown recession. There's nothing in between. The smallest increase in the unemployment rate, trough to peak, is either between 0.5 and 1.9 percentage points. There's nothing in the middle, which I think is pretty interesting statistically. Now, he did recognize that as a statistical, just a statistical result. There's no economic law behind it, but the track record is 13-0. So think about the odds of flipping a coin 13 times and coming up heads every time. After a while, you're sort of going to believe that the next flip is going to generate the same result.
Bill, take us back to first principles. Why can't they just cut and say one and done and we'll observe versus our addiction to measured?
Well, I think what will happen is once they start to cut, they'll probably keep going. Once they start to do the first rate cut, they basically decide that monetary policy, that we've accomplished our mission in terms of inflation and unemployment. Policy is restrictive, so we now have to go back to neutral. Neutral's not 25 basis points away. So if you have a rate cut in September, it's probably going to be followed by rate cuts, at least 1 or 2 more rate cuts later this year.
Bill, it seems like this was a setup for Jackson Hole. We've been talking about that. And it seems like there will be some sort of policy regime shift that we will observe in August. What do you think it will be?
I don't think that Powell really needs to say much more than what he said today, frankly. I mean, I think the changes in the statement and the press conference today basically tell you that September is going to happen unless the economic outlook changes materially. Now, that's possible. You could get a...
So starting on the main wires now, Iran's supreme leader orders a retaliatory attack on Israel.
But I think in the next 6 weeks or 7 weeks, is the outlook going to change materially? I doubt it. So I think regardless of what happens in Jackson Hole, I think the Fed's going to cut in September. I think, Powell will sort of check in at the Jackson Hole and basically, probably confirm that we're still on track for this result for rate cut in September. But I don't think it's, I don't think he has to use it for that.
Well, although it's not just about September, it's not just about whether they're going to move again one more time this year. It's about what the destination is. It's about the pace. It's about what the goal is in terms of just the view of where the economy is. Bill, do you expect there to be any discussion about the terminal rate, about what it means to be neutral at a time where this is a very different economy than pre-pandemic?
Well, I would assume that once you get inflation, you're highly confident inflation is going back to 2%, and you think the labor market's in balance, then you presumably you want to go back to a neutral
So
monetary
looking into
policy.
this then, as
The
Iran's
question is,
supreme leader
what's
has issued an order for Iran to strike Israel
question of what
directly in
is the
retaliation
level
for the
of
killing
R-star,
in
the
Tehran of
neutral
Hamas's
federal
leader.
funds rate. I think that neutral is clearly,
So in an
lower
emergency
than where we
meeting
are
in
today.
Iran
But is it 100
Security
basis
Council
points
this
lower
morning,
or 200
shortly after
basis
Iran
points lower?
announced
That
Hanai had been
remains to be
killed,
seen. So the
they
Fed
said that
could be
3
sort of
Iranian
feeling its way.
officials,
Now, obviously,
including
if
2
we fall
members of the
into recession,
Revolutionary
then the
Guard,
whole
who
story
have asked not
changes.
to be named,
Because in a
did say that
recession
Iran's leader
environment, the Fed
ordered
doesn't
an
want to go
attack
to a
on
neutral
Israel
monetary
for the
policy.
killing.
They want to go to a stimulative monetary policy. So if we actually, if it turns out with the benefit of hindsight that the Fed is late and we have a mild recession, then the Fed's going to cut rates much more dramatically.
Bill, I've never said this. I've got Dudley, Krugman, and Blinder on the same page. Never did I think I'd say that. The money paragraph from your good friend Alan Blinder. Any such early cut should be accompanied by a warning not to expect a steady stream of rate cuts. He alludes to the ECB. Do we need some ECB religion at the Eccles building?
No, I think that the Fed will probably cut more than one because once you start to cut, you're basically saying, I think it's time to remove monetary restraint. And monetary restraint is not going to be removed with just 125 basis point rate cut.
Bill, great to get your thoughts. Appreciate it. Bill Dudley there, the former New York Fed president, weighing in on this Federal Reserve decision as he got a lot of people talking over the last week about the need to move in July at the meeting that's just passed. I want to bring you a headline. Comes from the New York Times and it reads as follows. Iran's supreme leader ordering a retaliatory attack on Israel. The New York Times citing 3 Iranian officials briefed on the order. This is what I can tell you about crude. Crude's been rallying all day, and the price of crude looks like this at the moment. Brent crude up by 4 percentage points. TK, you would often say overtaken by events. The last thing this Fed needs over the next month or so is an energy price shock.
I'm so glad you brought this up, Jen. We led off the show this morning with Ethan Bronner, our Tel Aviv News Bureau chief, encyclopedic on the region. And he says the position here now is unprecedented, and he made clear there's going to be immediate news following both from the north to Lebanon and the news that you just have from Tehran as well.
As we get those updates, we'll bring them to you. I just want to reset. If you are joining us, we've just had a Federal Reserve decision in the last couple of hours. Interest rates unchanged. Incremental changes to the statement. There was a sense that in September, the Federal Reserve chair would set us up for a rate cut in September. He took a baby step towards doing so, and the market picked up on things accordingly. Big rally across equities, on the NASDAQ, on the S&P, on a Russell. It looks like this right now. It fades just a touch, but we're still higher by 1.4% on the S&P. Bear in mind the NASDAQ was poised for the worst month of the year, and at one point in the last couple of hours was on course for its best day of 2024. That fades. We're back down to about 2.7% higher on the session on the NASDAQ. We referenced this stat a little bit earlier on today, a few times. We are now on course for the 7th consecutive Fed decision day rally on a 2-year bond. Lisa, that yield is lower by 6 basis points.
How much is this just that Jerome Powell tends to skew dovish, and how much is this that the market still has a probability or a possibility baked into what the yield is that the Fed could maybe surprise in a hawkish manner? Either way, this is a market that likes to hear Fed Chair Powell speak, and today was no different.
Mike McKee was in the room with the Federal Reserve Chair down in Washington, D.C. He joins us from the nation's capital now. Mike, you've just got outside. Walk us through your biggest takeaway from that news conference this afternoon.
Well, I think what you walk away with is what Bill Dudley was talking about. If the economy doesn't do something weird, change positions, change directions, then the Fed is going to be cutting in September. But there are a lot of potential twists and turns between now and then. Friday is event risk with the jobs report. And of course, you just mentioned the situation with Iran. I don't think the Fed was taking those things into consideration today as reasons not to move today, but they do have to worry about them and what might happen. Right. So they will, at this point, be on a cutting course unless something significantly changes. And I think that was the message that Powell wanted to deliver. And I think Bill put it well when he talked about how the statement was skewed to the doves a little bit, and the news conference maybe to the hawks, and that both sides get something out of it.
Mike, you've been doing this for a few years. Back to McChesney Martin. We almost printed a 406 10-year moments ago. Can the bond market tell the Fed what to do?
Probably not. And one of the things that you have to keep in mind is that we have all this international news going on, and the U.S. bond market is the haven market. So a certain amount of what's going on today is probably in reaction to Israel and Iran, and a certain amount of it is the politics going on in this country. And then on top of that, what the Fed is considering and what the economic data are showing. But I suspect today's less about the Fed and the data than it is about other things, because the market had pretty much priced for a September rate cut. They didn't get any surprises out of the Fed today.
Mike, you're referring, of course, to the news that John broke about Iranian Supreme Leader ordering an attack on Israel for the two assassinations that Israel carried out. Right now, we're seeing crude markedly higher, particularly Brent crude. Mike, I wonder how this relates to what Fed Chair Powell has been talking about, that this is actually better inflation data today than it was, say, late last year or earlier this year, simply because it is not being driven by goods. It is being driven by the employment market. It is being driven by services. How much do you believe, based on those comments, this is a Fed that is willing to look through good side inflation and focus much more on something else?
Well, I think they are, especially if oil prices go up only temporarily. The problem is if oil prices go up for quite some time, then that feeds through into the real economy, particularly on the services side. You'll see surcharges by delivery companies, airline fares might go up, that sort of thing. So they're going to have to keep an eye on that. But their general instinct would be to look past any kind of energy price change that comes about that they think might be temporary. And at this point, we have been waiting for a major shift in energy prices since October 7th, when the first attack on Israel came. So we haven't seen it yet. Let's see whether this holds or not. And then the Fed would have to take it into account if it's still going on.
5% rally in crude today. Mike McKee, great work as always, sir. Appreciate it. We'll catch up with you a little bit later. This week's not over. Still got some work to do. The Fed decision behind us. Tomorrow, we'll get jobless claims. On Friday, we'll get a payrolls report. And we'll be catching up with Jeff Rosenberg of BlackRock. We can do that now. Jeff, at 8:31 on Friday, will this decision today to do nothing, will that look like the right one?
Well, you know, it might look like the right one, but I think the point you're also getting to is that Friday, and we'll see on Friday as well, is going to be much more consequential. But I think the important point about how it's going to be more consequential is what we've heard from everybody so far, what we've heard from the chairman and in the statement, is this is very much setting the table for September. And the bond market had already priced that outcome. And so what you look at into Friday and the payroll is you're setting up the bond market, perhaps broader markets, for a very asymmetric outcome. If the data is much, much stronger, then you're going to have some disappointment. If the data comes in along lines of what Chairman Powell was talking about in terms of gradual normalization, or even, you know, a little bit weaker than that, the market will continue to price in this path of a cut in September, a cut in December, and even more into 2025. So I think Friday, the risk is really on the upside, that you get a surprisingly strong payroll report, and that has to call into question whether or not policy is really as tight as it is. And that's really the issue. Everyone's kind of saying, hey, this is right, the Fed's got it right. The Fed's saying we've got the soft landing. We want to secure the benefits of soft landing. But he kept repeating PDFP at 2.6%. You look at the GDP number that just came out. You look at Atlanta Fed GDP Now forecast for third quarter. We are well above, in growth terms, anything associated with long-term sustainable growth. And so, yes, we've seen some signs of restrictiveness, but how much of that
Hold up, Jeff, because you're
that's where the asymmetry
totally
comes
against the grain, totally against the grain. And I think you know you are. Most of the people coming on this show right now, if they're going against the Federal Reserve, they're saying it's because they think this Fed is too tight, not restrictive enough. You're making the point here, Jeff, that maybe they're not as tight as they think they are. Now, that really goes against the grain, Jeff. Is that the point you're trying to make?
That is the point exactly that I just made. No one's really talking about it because the Fed's not talking about it. But the data is what your question was about. What happens on Friday and how does that make this moment look? Well, if the data comes in continually stronger, then we're going to have to start to talk about that. Now, I'm not saying that that's where we're going. Where we have been, and what we tend to do is to extrapolate where we just have been. So we're extrapolating out the benefits of the gradual slowdown in labor markets, the normalization. ECI is another great data point. There's nothing in the crystal ball that says that that won't happen. But your question was, what if it does? Then you start to think about these things. And my point is, everyone is so one-sided on this point that the asymmetry to the market reaction is much greater to the upside surprise and strength on Friday than it is to coming in line or even being weaker.
So let's put a call around that, Jeff. Are you basically selling 2-year notes right now, trying to lock in because you think that this could be the highs, given that they are not recognizing the risk of an upside surprise to the jobs report?
No, I wouldn't say I'd go that far, but what I would say is it tempers some of the enthusiasm for adding to 2 years at this point when it's all in the price and even more so relative to what the Fed is saying that you're going to get. So the bar is a little bit higher to what do I do with this information in my portfolio when you look at, well, you know, the bond market's really quite priced a lot of that in. So it makes it a little bit more tricky than just saying, oh, the Fed's going to cut rates and I should back up the truck and buy a whole bunch of duration. Well, a lot of that trade has happened in the last month. So if you're just talking about maintenance cuts and the degree of maintenance cuts that are required, is what you were talking about with Bill Dudley a minute ago, we don't really know where that neutral is. So how do we know where neutral is? You know it when you see it, meaning you know it when you see it in the data. So if the economy doesn't slow and that unemployment rate doesn't continue to rise, and it says you're not so restrictive as you think you are. And I think, you know, we just kind of have a pile up on one side of the debate here when the data is still saying 2.6% PDFP. He said it twice during the press conference. He also said the other thing that has been supportive of restrictiveness, interest rate sensitive sectors and the slowdown in the labor market. But it's a more balanced view around this debate around how restrictive we are than where the market is kind of lining up. And that sets up an asymmetry to the outcomes.
Hey, Jeff, you're a great student of history. And if we have the headlines that John Farrow was talking about there of Tehran and Israel, and for that matter, up to Lebanon as well, how far out the full faith and credit curve does politics, does war, do our fears play in? Is it short term? Is it out to the 2-year pinch? Or is it out even further to the 10-year note?
So I'm going to frame that in that question, or my answer to that question, in terms of how does the kind of flight to quality response in the bond market play out in this environment. I've said this on the show maybe a couple of times. We've written about it. That flight to quality during the QE zero interest rate policy environment was a curve flattener. If you're very close to zero rates in the front end and you're looking for portfolio protection, you buy it in the long end. Today, we're in a very different environment, 5.25 to 5.5. There's plenty of room for the front end to go down. And so it's more of that pre-GFC kind of bond market reaction where flight to quality is a steepener and it's in the front end of the curve. So I think you see the most powerful reaction. It's hard to disentangle the high frequency between the news that Jonathan broke and the result of the press conference, but you do see a little bit of a steepener move into the market. Again, hard to disentangle the two, but I think when you take a step back, flight to quality now is the steepener trade, and your better yield response is going to be more in the front end in this kind of environment.
What's interesting to me today, Jeff, is what's not rallying on the heels of some of those headlines, especially in light of the Fed's dovish tilt, yes, but they did not cut rates. It's that the dollar is not catching a bit. It's weakening pretty dramatically. You're seeing the Bank of Japan very happy today. They're getting what they wanted in terms of a little bit more yen strength. How much is this sort of the new narrative that in a flight to safety type of moment, if the Fed is going to cut rates and not recognize that upside risk, you will see persistent dollar weakness heading into next year?
It's a tricky one, Lisa, because, on the one hand, you've got kind of interest rate differentials driving some of those dollar moves, clearly with the yen, balanced against the other side of flight to quality, which is the pure risk-off trade, is usually dollar strength. You go for the strongest institutional protection in terms of wealth, and so I think initially the move is much more about interest rate differentials, and that's why you're not seeing so much of the move on the dollar. I think it's too soon to say whether or not you're going to see a bid to the dollar from geopolitical risk. But I think if it was a larger issue that spreads, you're going to think more traditionally that's going to be dollar strength.
You got to jump, John, and gold up $41.
Got a big rally in the bond market too, and equities as well. Jeff, just final question before I go. There's people watching, listening to this program right now. They just want to know, can I buy the S&P 500 and take a vacation? Is there anything to worry about between now and September?
Well, you never want to say take a vacation.
No.
Buying equities, you've got some risk. But you take the totality of what the chairman went over. And this is a lot of good news. I mean, this is a chairman basically saying, without saying it, we've achieved the soft landing. That's a great outcome for the equity market. It's a great outcome for the economy. It's a great outcome more broadly. So I think that's the takeaway, and generally that's going to be pretty supportive. I think the other thing just to mention, obviously, you're not really buying the S&P 500. It's not the economy. It's a collection of stocks that has a very high weight to a secular technology theme, and that secular technology theme is playing out again today following Microsoft's earnings. You're seeing a bid back to semis. So you've got like the micro story there a lot, as well as the policy story. And we got to keep that in mind when we're looking at this high frequency data. And if you're buying the S&P 500 with a very high historical share to tech, it's really also buying into that tech story as much as it is about the macro economy.
Just trying to take a vacation. Jeff, appreciate it. Jeff Rosenberg there, BlackRock. Jeff, thank you. Deeply thoughtful stuff going into payrolls on Friday. We should share with you the numbers that we're looking for on Friday. Just another sneak peek of the payrolls survey here at Bloomberg. The median estimate is 175 on Friday. The previous number, 206. Unemployment coming into focus much more for many of you, I know. So here's the estimate for unemployment, 4.1%, in line with the previous month of 4.1%, Lisa.
And the reason why it matters, that unemployment rate, possibly more than anything else, is because if it gets to 4.2%, it triggers a SOM rule. Bill Dudley talking about why that's important. At that point, historically, it becomes a self-reinforcing mechanism of weakness.
The difference is you and I are taking vacation like 18 hours. Pharaoh's taking 18 days. That's the difference here.
Actually, I'm missing Friday because I'm going to be on vacation.
Thank you.
You're missing job day? That's un-American.
It had to do with kids' schedules.
Look, as a manager here at Bloomberg.
Blame it on the kids.
As a manager here at Bloomberg.
Are you going to blame it on the kids?
I track everyone's vacation.
Oh, do you?
Absolutely.
Yeah, is that correct?
You've both taken much more than I have.
Oh,
okay?
Please.
Just for the
record. Do you
record.
have a bar chart of it?
I do. At home, it's a spreadsheet. I load up the Bloomberg terminal and I monitor your vacation at the same time.
That's such productivity.
Missed this, haven't we? Appreciate it. It's good to see you, TK.
Yeah, please.
Thank you, sir. Lisa, thank you.
Thank you.
Are you going to bless us with some of your criticism of the Federal Reserve tomorrow?
Yes, I'm going to have commentary that blesses them very frequently.
Is there an auction tomorrow?
No, but there
That's
is
the line of
plenty
the press
commentary.
conference. That really is. Coming up on the close, don't miss this. Stuart Kaiser of Citi, David Kirkpatrick of Techonomy, and a former Fed Governor, Betsy Duke, as we round out the month of July from New York City. This is Bloomberg.
Power Players is back this September. As the top names in tennis take the court over in Queens, we are convening the best of the sports world right here in New York. We'll host some of the most influential voices in the business and identify what happens next for players and fans in this multi-billion-dollar global industry. Bloomberg Power Players, September 5th. Register now at bloomberglive.com/powerplayers.
How do we reach down to the 18 to 35-year-old market? How do we bring these kids, these influencers, this new generation of people interested in the game of golf? There's 738 million people in the world who are interested in the game of golf. Don't play the game of golf, but interested. There's about 60 million golfers. So we have another 670 odd million people we can go figure out how to get them interested, not just in live, but in the game of golf. And so we sit down and you talk about this internally with your production team, you talk about with your marketing people. When you look at our audience base today, that we have like about just around 50% of our ticket sales are 45 years and old and younger. Following the PGA Tour, it's the oldest aging demographic in sport, is 67 and a half. So in a matter of a year and a half, basically, we've pulled that 67 and a half down to 45 because of our product, because of the entertainment side. There are places around the world where 32% of our tickets.
So 1 minute remaining now for the market on close imbalance.
They're coming to an event that they feel inclusive with. All right, so all of a sudden we're seeing these data points coming out going, my gosh, why haven't we're owning this?
Power, money, culture. As Linda Ammon tells the story of Asia's rise through the people who are helping to shape it. On this episode,
Asia's here. Asia's here.
inspired by the fusion of East and West,
I'm like the ambassador of the two worlds.
Hong Kong designer Vivienne Tam explores a future where fashion and technology meet.
When a lot of time when people say, Vivian, it's not possible, I say, try it. It's possible.
Latitude. Encore presentation this weekend. Only on Bloomberg.
Okay, so we're looking to the market on close imbalance now. The S&P 500 seeing 1.1 billion to the buy side. So the NASDAQ 100 seeing 715 million to the buy side. So that's to the sell side there. The Dow 30 stock seeing 200 to the sell side. And Mag 7 stocks are seeing 55 to the buy side.
This is the countdown to the close. I'm Romain Bostic alongside Alex Steele and Scarlett Fu. On the heels of a Fed meeting, we talk about a rate hiking cycle that began almost 2 years ago. A rate hiking cycle that, if you believe what Jay Powell had to say today, might officially be over.
Yeah, but for now, it's higher for longer. I wonder if he could have just wrapped up the press conference by saying, wait for Jackson Hole.
Oh, maybe. There we go. That's how you're going to lay the groundwork for September. Just to check in on the markets here, you had the S&P already grinding its way higher today, but you can really see a tick higher as the statement came out, particularly when Powell talked about September. We have a little bit of a dip, though, into the close. Also, the two-year yield, guys, that's a perfect example of what we're looking at. There you go. He says the word September, and yields go down for the day, down by about 6 basis points. I feel like this chart tells the story.
Absolutely.
It's kind of interesting, too, to see just how many times that September narrative kept coming up again and how many times he was willing to lean into it and not shy away from it. Obviously, making it clear, nothing's been decided, as he always likes to say, but it sounded to me like maybe some decisions might actually be on the table.
Maximum optionality, right? That's been the mantra this whole time. Well, we know Fed Chair Jay Powell hinted that rate cuts could be on the table this fall, perhaps September, but only the data really boosts their confidence. Take a listen.
The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
For some market analysis, what the impact of all this is on equities, if at all, let's welcome Stuart Kaiser. He is head of equity trading strategy over at Citi. And Stuart, I know before the FOMC decision and press conference, your take on this was that markets, at least in equities, are really much more focused on earnings. Did this idea of a rate cut in September change that idea?
I don't think it really changed our base case. This morning we were really rallying on, the Microsoft earnings from last night and some related earnings there. The FOMC, I was actually kind of surprised. I mean, the statement was a little probably more hawkish than the market might have expected, and equity futures didn't react as much, which did surprise me. I think once we got into the press conference and it became, clear that the Fed was sort of parroting what we've seen from the data, right, which is a solid labor market, easing inflation, and kind of a cut-minded FOMC, the market did respond positively to that. But, if I were to rank out the big catalyst this week, I would probably put earnings and payrolls a little bit ahead of the Fed in terms of the impact on markets. And I think that's kind of largely what you saw this afternoon in totality.
When you talk about, Stuart, the idea of what this market is pricing in with regards to rate cuts and this idea here that the Fed, at least right now, seems to be leaning into this idea that the data is pointing them in that direction, will that take precedence, whether it's at September, November, or in the December meeting?
Yeah, Ryan, it really does matter, especially to the extent that they're actually cutting rates into a solid economy. And, our view coming into the year was you don't need rate cuts, but if you are getting rate cuts, it's the why that matters. And if they do 2 or 3 cuts and you're priced for about 2.5 cuts in the fourth quarter, and that happens against, let's say, payroll data that's still 150 to 200K, I think the markets will respond exceptionally positively to that. If they end up cutting, but it's in response to a weaker labor market, to me, that's a much, much different discussion. And I do think you have to worry about equity risk in that case. So, yeah, look, I do think insurance cuts in the back half or in the fourth quarter this year would be extremely positive for the markets. But, the real question is going to be, are they cutting into a strong labor market, or are they cutting because they're really worried about a deteriorating labor market in the next few months?
Yeah, which sets us up for Friday. And it was very apparent in Powell's presser that the jobs data is that critical metric for a September cut. What are the options market? What's the options market in the S&P telling you for Friday now?
Yeah, I mean, you're pricing, something like a 1% move on Friday, which is a pretty large implied move ahead of a payrolls print. That said, you also get Apple and Amazon after the close on Thursday. So I think that 1 to 1.2% move has kind of been fluctuating throughout the day. I think that's capturing payrolls as well as those kind of key earnings prints. But look, our baseline view for equities this year is you run long equity risk unless and until the U.S. labor market comes under significant pressure. It does seem like the Fed is also kind of navigating in that direction, too, with kind of payrolls as the number one thing they're focused on. So it doesn't surprise me to see a lot of risk priced into payrolls because, we do see it as kind of the key risk indicator for markets. Consensus about 175K. Our U.S. economists are actually a bit below that. And I do think if you printed something sub 150K, it would definitely get the market's attention in terms of, kind of a broader slowing in U.S. labor markets.
Stuart, you say that earnings matter for the big cap tech stocks. Clearly, the jobs report matters for the equity market as well. Do earnings matter for the Russell 2000, or is it still a rotation that continues because of the macro trends?
Yeah, look, I do think earnings obviously matter for small cap. It's a little tough because, only about 700 stocks in the Russell actually have positive earnings. So, like the day-to-day, what is EPS on the Russell probably matters a little bit less than are we continuing to get soft landing data. But, so I think earnings matter more for S&P and NASDAQ right now, sort of, tick by tick, day by day, what are companies reporting. But look, the Russell is a more growth-sensitive equity asset, and it's going to respond to that growth data because it is translating through to, what is the earnings profile and what is the credit risk of those small cap stocks. Honestly, one of the things we've been really focused on with investors is owning small cap, but doing it through that smaller kind of 600 to 700 stocks within the Russell 2000s that actually produce positive profitability.
Those correlations still there, Stuart? I mean, when you lay out that scenario, that sounds to me a little bit more idiosyncratic rather than something that is broadly defined.
Yeah, look, I think coming into earnings season, folks were looking at least at large cap tech earnings as a little more idiosyncratic. But the problem or the challenge is within that tech ecosystem, there's a lot of feedback, right? The CapEx that's getting spent by, let's say, a Google or a Microsoft or a Meta, that CapEx is then getting kind of consumed by NVIDIA and the semi stocks. So as much as you do have some idiosyncratic stories, you also have, I think, this very strong interlinkage amongst those large cap tech stocks, which is why the Google report last last week, which kind of hinted at maybe some weaker CapEx, became so disruptive. At the Russell level, yeah, I think there's a lot more.
So keep in mind we're just under 3 minutes away now to the cash equity close for the US, after which we get earnings season continuing. Another Mag 7 stock printing today. That's Meta printing their Q2 2024 earnings. It's at 5 minutes past the top of the hour. Their estimated EPS is $4.75, with an estimated revenue of $38.34 billion.
Change and the financial markets largely unmoved as we push ahead now to a whole slate of earnings coming after the bell, guys. That includes Meta, Etsy, Qualcomm, Carvana, and MGM, and quite a few others.
Yep, and we got eBay as well. I think Meta's going to be quite interesting, right? It's like, as an investor on Meta, do you want to see them spend more on CapEx? Probably not. But if you're looking at growth and nice hyperscaler CapEx, you want that growth in the market, maybe you then do want them to spend.
And come on, the advertising business is doing well. They've got the Summer Olympics. They've also got the election, and the election is only heating up. So the outlook for advertising seems pretty solid.
All right, looking at the 7th consecutive Fed day now, where we've seen the short end of the Treasury curve move lower and a huge rally going on in the equity space. Strongest day right now for the S&P since February. This is Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Alex Steele here to help take you through the Closing Bell, a global simulcast. It starts right now with Scarlett Fu alongside us in the television studio, Carol Masser and Tim Stenovic in the radio booth, as we welcome our audiences across all of our platforms, including our partnership with YouTube. A day where we're looking at an S&P having its best day since February of this year. The NASDAQ 100, Carol, having its best day since February of last year.
I don't know about you guys, but I lost count of how many times Fed Chair Jay Powell said September, and I feel like that specificity was so important and
I know,
a key
I thought
takeaway.
at some point like Earth, Wind, and Fire was just going to like pop out.
I love that you think that way. Cue the song, cue the song.
Okay, though to be fair, he did say we've made no decisions about future meetings, and it includes September. Will be data dependent, but not data point dependent. I didn't hear September in that part.
I'm just going to say.
Yeah, no, I mean, they're setting it. I think the question is, are they dragging their feet or are they taking baby steps? And how you kind of look at that. I saw notes from a lot of economists referring to either one of those.
Well, I mean, he needs to create room for optionality, and he certainly gets that with Jackson Hole in late August. So you wonder how much they're going to say September and Jackson Hole as well.
It'll be interesting to see whether he uses that platform. It's kind of interesting. We heard from Bill Dudley during the Fed special. He kind of talked about this idea here that if the Fed does indeed cut that first rate cut, he thinks they have to keep going. They can't do like what you're seeing over there in the ECB as sort of do one and then wait. That if this is going to be an easing cycle, in his words, it needs to be an actual cycle.
And he said several, right? Like he said
Yes.
the word several.
Yeah.
So it just depends on what the word several actually means. Is that 7 or is that more like 3 or 4?
That next meeting, of course, September 17th, 18th. Apologies to Earth, Wind, and Fire that it did not schedule it for the 21st. We get the closing bells here in New York on this Fed day, Wednesday here, with a lot of earnings set to cross the wire. Dow Jones Industrial Average up 100 points or 0.2%. The S&P 500 up about 1.6%, while the NASDAQ Composite higher by 2.6%, and the Russell 2000 also in the green by about 0.5%. Carol.
All right, folks, let's get to Qualcomm earnings. Great read on certainly the smartphone market. So let's get to it. Let's get to the outlook. Fourth quarter revenue, $9.5 billion to $10.3 billion. So kicking it up, the estimate on the street is $9.7 billion. Fourth quarter adjusted EPS, $2.45 a share to $2.65. The estimate is $2.45. So again, upping both the top and bottom line. Go backwards. Third quarter adjusted revenue, $9.39 billion. That's a beat versus the estimate of $9.21 billion on the street. And third quarter adjusted EPS, $2.33 a share. That's 9 pennies better than what the street was expecting. And that stock you're seeing up 2-3% here in the aftermarket.
Yeah, certainly waiting for some commentary. The company has not updated its financial results on the website yet, so we don't have the press release. But it does see fourth quarter revenue 9.5 to 10.3 billion. Estimates for 9.7 billion. Shares up by 5.3%.
And just quick mention here with NVIDIA's move today, it was the biggest gainer in the NASDAQ 100. On that positive note out of Morgan Stanley, it added $329 billion in value today. That is the most in market history, $329 billion.
Yeah, I was looking at the Philadelphia Semiconductor Index earlier today, and up the most going back to late 2022. Everything in there other than Skyworks and Energis were in the green, and solidly in the green too.
Yeah, well, a batch of semiconductor, right? ASML getting a boost, right? There's some exemptions maybe when it comes to some of the chip equipment makers. ADM, Advanced AMD rather, Advanced Micro Devices, right? Also their report upbeat in terms of their forecast. So there was a lot of news, I felt like, in the chip
also.
space.
Intel making some big news yesterday with layoffs. So, yeah.
And it'll be interesting, too. We get Intel reporting tomorrow, too. So maybe some of that gloom and doom or these doubts here about some of these chip companies, maybe they'll start to ratify some of those valuations. In fact, we're getting more earnings right now out of ARM Holdings, too. Of course, a big one there with that company providing guidance, saying that revenue for the quarter going to come in at about $780 to $830 million. So basically a preview here of that second quarter. And the revenue in the most recent quarter, the past first quarter, the fiscal first quarter, a beat there as well. 939 million. Street was looking for 906.
Yeah, that's a pretty incredible number. Also, just go back to Qualcomm for a moment. They're taking a look at that fourth quarter revenue on the high end of $10.3 billion. That beats estimates. Also taking a look at the individual segments, right? You have QCT, which is basically what they make for their phone chips. That's coming in quite strong on the high end of about $8.7 billion for the fourth quarter. So these are solid numbers when it comes to guidance. Their licensing revenue also on the high end, coming at $1.55 billion on the high end for the fourth quarter.
You know, a lot of it will depend on what they say also in the conference call about their outlook for the following fiscal year, because that's when Apple's new generation of iPhones come in and the refresh cycle that's supposed to take place there. They're going to provide a really important read on demand from Apple.
Is this new phone? Is this the one that folds?
No,
this
not
is
yet.
just AI stuff.
Oh.
No.
Are you looking forward to that one? You want the fold
You got to wait a few years for that
I'm over
one.
folding.
Samsung does have a folding phone out.
I've heard.
Apple, not yet.
Yeah,
if that happens.
Yeah.
If that happens.
If it happens. But it will be AI capable, right?
We're also going to look
phone,
for we're going to look for some commentary out of Qualcomm in terms of China specifically, also AI. Certainly, that's an aspect for them. But this is, you know, we've seen in terms of some of the phone market and the handset market some weakness. So we're looking, you know, for more commentary about.
We are now shortly expecting earnings from Meta Platforms.
The strength of the comeback, if you will. But you are seeing Qualcomm now, guys, up about 7% here in the aftermarket. This is building on a more than 20% gain here in 2024.
Yeah, they did update at Investor Relations website, so I am able to look through the press release. Cristiano Amon said that third quarter results reflect strong execution of our growth and diversification strategy. With QCT quarterly revenues and EBT margins at the high end of guidance, we're excited about the launch of Snapdragon Series X solutions for PCs and personalized AI experiences. It represents a significant milestone in our transformation from a communications company to a leading intelligent computing company.
I am curious to see how they articulate their longer-term future, particularly given all the reporting we've done at Bloomberg about Apple trying to basically distance itself from Qualcomm with its own chips and things. And obviously that's been pushed back, according to Mark Gurman. But at some point, this is something that Qualcomm is going to have to confront head on.
I just want to hit on ARM Holdings just for a moment here. So just a reminder, their first quarter results came in about 40 cents a share. That beat their revenue, also beat their second quarter forecast. I mean, it looks pretty solid on an adjusted earnings basis. The high end just met.
Earnings coming through from Meta now. EPS a beat at $5.16. That's on estimates of $4.72. Their revenue a beat at $39 billion. That is on estimates of $38.34 billion. Ad revenues a beat $38.33 billion on estimates of $37.57 billion. The family of apps revenue, that is a beat at $38.72 billion on estimates of $37.76 billion. Operating income a beat at $14.85 billion on estimates of $14.59 billion.
Beating the consensus estimate of 38.34, and the outlook for this quarter revenue $38.5 billion to $41 billion. Analysts were looking for $39.16 billion, and capex for the full year $37 billion to $40 billion. It had previously seen $35 billion to $40 billion. Analysts were looking for somewhere in the middle of the lower end of that range, $37.5 billion. So like all the other big tech companies here.
Well, and this is going to be potentially worrisome, right? When they talked about it last time, we saw certainly the stock take a hit. So giving some clarification around it, but it's not like they're reining it in. The street was looking for it to maybe pull it in even more. If you look at the top end, they're saying it could go to as much as for the fiscal year up to $40 billion. The estimate on the street was below that by about $2.5 billion. So we're looking at Meta Platforms, though, up 8% here in the aftermarket. Also talking about fiscal year total expenses, 96 to $99 billion, a bit of a gap there. The street estimate is 97.73. So again, that can be on the higher end. But again, right now, Wall Street seems to be taking it in stride here.
I think it's notable what Mark Zuckerberg said in the press release, that he led with AI. He doesn't talk about the family of apps and the record revenue that they had there. He said we had a strong quarter. Meta AI is on track to be the most used AI assistant in the world by the end of the year. We've released the first frontier level open source AI model. We continue to see good traction with our Ray-Ban Meta AI glasses, and we're driving good growth across our apps. So he does mention the apps there, but he mentions the Ray-Bans before the apps there. I mean, that's like a tiny part of their business, but maybe that's where he sees the growth of the company.
Maybe that's where he does see the growth, and of course that feeds the conspiracy theories about those tan lines that we were talking about last week.
I knew you were going to bring that up.
Kind of interesting as well, too, when we talk about CapEx, how that CapEx spend basically staying in line with estimates for 2024, a ramp up in 2025. But I thought it was also interesting, too. I was looking at some of the ad numbers here, and ad impressions coming in, growth of about 10%, which was slightly below what the street was looking for, and a huge drop from the prior quarter a year ago, when we had about 34% growth, though. That was probably a bit of an outlier.
I just want to highlight for a second the Reality Labs thing. So Reality Labs is saying operating losses will continue for 2024. Their operating loss for the second quarter came in at $4.49 billion. So just to contrast the fact that that area of their segment, right, their virtual reality is losing billions of dollars. It will continue to lose billions of dollars this year, yet CapEx will still be on that high end of $40 billion. How do you reconcile that as a shareholder?
Is it maybe because but the quarter that I just reported on, maybe because there are some beats there, and so maybe they think that they can manage the expectations? It's pretty kind of mind-blowing, because I would have anticipated that the stock would have traded lower on all of those costs. Right now, Meta is up about 5% here. You've got Qualcomm up about 4.7% in the aftermarkets. ARM holding down 7%. Etsy also out, and it's gaining about 2.9% in the aftermarket. So a big drop of earnings. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We will see you again, same time, same place tomorrow.
And our coverage continues here on Bloomberg Television, keeping a closer eye on Meta. Those results just coming out, 22% revenue growth in the most recent quarter on the back of advertising, but a big focus, of course, on costs. The company basically saying that its CapEx spend in line with estimates for 2024. A bit of an increase expected for 2025. Mandeep Singh joining us right now, who covers this company for us over at Bloomberg Intelligence. Mandeep, what was the most important thing in this release to you?
Ad pricing. I mean, the fact that ad pricing grew 10%, it's a very positive sign that they are applying all those AI chips to good effect in terms of getting more money from the advertisers. And ad impressions going down actually may not be a bad thing, because prior to this quarter, they were increasing ad loads to drive up the ad impressions. Well, guess what? They don't have to show more ads, but the ads that they're showing are getting more money from the advertisers, which is why the ad pricing went up. So actually the quality of the beat was much better than what I anticipated. And, you know, CapEx numbers not going up is also a positive, because that was a big risk.
Yeah.
How long can they keep spending, and will investors be patient here?
So it's like the ARPU goes up for the advertisements.
Exactly, yeah.
So in terms of a breakdown on that ad growth, I mean, what are you curious about in terms of the Reels business, which is kind of a clone of TikTok, versus Threads, which is a Twitter clone, and right now doesn't even have advertising?
Yeah, I mean, Reels is almost 50% of their engagement right now. So look at how quickly they have transformed the entire business. I mean, Instagram, Core Blue app, all the video content has come about in the last 2-3 years. That's where they made that big push. And Reels is almost 50% of the engagement time. A lot of the ad impressions they were showing on Reels weren't monetizing that well. I think this print shows they're actually monetizing their video ads probably better than YouTube at this point, because YouTube, remember, didn't have a very good quarter. So this quarter actually kind of shows that Meta is doing better in terms of ad monetization.
So the whole Reality Labs operating loss, just kind of, we're cool with that?
Well, when you print numbers like this, I think you get a pass, because even though you are losing, that's another level they can pull. You know, if investors were to, you know, ask them to be more kind of efficient with their spend, guess what? They could pull that lever, but they don't have to, given operating margin expansion and the tailwind we saw with ad pricing this quarter.
Yeah, they've earned it through their ad growth. Mandeep, thank you as always. Mandeep Singh of Bloomberg Intelligence giving us the instant analysis to Meta's results. And of course, Meta shares currently gaining right now in after-hours trade. Let's bring in another voice. David Kirkpatrick is founder of Techonomy Media and, of course, the author of The Facebook Effect. David, so good to speak with you. And let me just get your thoughts first up on the CapEx and in particular when it comes to the reality labs, the reality business, and how that money, that part of the business is still losing money. How much is Meta still spending on the metaverse despite it losing money versus AI? The CapEx number that it gives kind of covers everything, doesn't it?
Right, but if they're losing $4 billion on reality labs, which I just heard somebody say, they're spending way, some 95% of that is a capital expenditure that's just not generating profits or revenue. So, they have a strange view of the future, but I do think given their extraordinary ad growth, and as Mandeep just so very eloquently laid out, and the potential they have to continue making so much money from advertising, they really can continue to invest both in AI and in their sort of whimsical metaverse experiment without really suffering very much.
Well, of course not. I mean, when you're generating $40 billion basically a quarter, which is basically the run rate now in revenue for this company on the top line, double-digit growth for a mature company, double-digit growth for a company that, I don't know, 2 years ago in 2022, everyone thought the party was over. And that's when they were doing all that big spend on the metaverse, which you know, David. Investors pushed back on it, letting it be known to Mark Zuckerberg. They didn't like it. He folded at some point, and investors embraced it. At least for right now, investors seem comfortable with these numbers.
He didn't totally fold it either. I mean, he's still spending an awful lot of money on the metaverse, but because of the extraordinary business performance that continues, and I think it's more controversial right now whether the AI investments will pay off, as you often discuss. This is a hugely confusing moment in the development of the technology economy. And I think every one of these companies is somewhat nervously competing with one another, attempting to outspend each other for a very uncertain long-term goal.
Well, David, that's kind of the point I wanted to make. So Google, their revenue comes in at $84 billion in the second quarter, and they get dinged. And then you have Facebook that comes in, and their revenue beats, but it comes in at $39 billion, and then they get rewarded. But they're exposed to ad sales, and ad sales is a global growth factor versus Google and data centers and cloud, which feels more like a structural shift. I just don't get it.
Well, I think majority of Google's revenue is still advertising, so I don't see it as that contradictory. I think it's weird the way that both Alphabet and Microsoft stock dropped after they beat estimates in the last few days. So, investors are strange. I don't think we can always figure out where their heads are at. But look, the fact is that Meta is an extraordinarily well-positioned, extraordinarily well-run company from a purely financial point of view. As you know, I have my serious critiques of them in other respects, but there's no question that the company is just roaring ahead with still the best targeting that any company has, with this extraordinary 4 billion user customer base we've never seen anything like this before. It's so easy to take for granted these companies, but they are moving into some areas that are world altering with very effective business models.
Yeah, a fifth straight quarter of double-digit percentage increase for quarterly revenue. One thing that people bring up a lot, David, is Llama, right? Mark Zuckerberg doesn't have to partner with an OpenAI because they've got their own large language model that they're training. It's open source right now, so my understanding is they're not collecting any licensing fee on it at the moment. You worry that this could be a source of problems for Meta down the road, maybe its ability to keep bad actors at bay. Walk us through your thinking here.
I don't think it's, from a financial point of view, I would not criticize it. In fact, I think it's generated a lot of enthusiasm in the marketplace and among developers. So open source AI has tremendous virtues from the standpoint of a business. The problem with open source AI is that people who are bad have more access to taking that code and using it in any kind of malevolent way they would choose, because they have access to the source code. That's why open source is open. And many of the other AI companies have chosen not to go that route because of their concern, in part at least, that that could be a risk. Now, it's in keeping with Zuckerberg and Meta's longstanding approach to all technologies, which is pretty much throw them out there, and if something goes wrong, figure it out later. That's just, moving fast and breaking things is still their corporate mantra, even if they prefer not to talk about it using those words.
What's sort of the next step here right now, David? Because we talk about this idea, this is still effectively an ad company, despite all the talk about the metaverse and Ray-Bans and all these other things. But clearly Zuckerberg has shown that he has ambitions to try to broaden this company out beyond that. Do you think AI, Ray-Bans, metaverse, whether this all gets folded into one in some form or another, is that going to be the future, or do you think this could be a head fake?
Oh, gee, Romaine, if I knew the answer to whether AI was going to be the answer, the successful profit-generating tool for these companies, I would be. But, nobody knows. But I think their bet is as good as anybody's. And I will say this. I am very negative on the metaverse name change, 4 billion loss, etc. On the other hand, if you look long-term, they might be able to find some interesting intersections between their extraordinary AI investments and Llama's success and whatever the metaverse thing turns into. So they have continued to express great confidence that we're going to be able to have sort of virtual presence look like we're actually in the same room. Who knows what AI will be able to do to improve that? So I don't bet against them from a technology development point of view.
All right, David, we appreciate it. Maybe that's what will happen when we take the clothes on the road. We can all be in different islands and do the clothes. Maybe in the metaverse? All right, David Kirkpatrick, thanks a lot, founder of Techonomy Media. All right, we got a lot of earnings for you that are continuing to come out. I'm taking a look at MGM. Overall net revenue coming in stronger than estimated at $4.33 billion. You had adjusted earnings also coming in at 86 cents a share. And I do have to say, their MGM China net revenue was up 37% year on year. And that was also a beat. So was the Las Vegas.
So following the close of the US cash equities markets, just going to give you guys a quick market wrap of the session today. So Federal Reserve Chair Powell's dovish comments helped extend a stock rally that began with a surge in key tech companies, propelling the S&P 500 to its highest level since February. Equities made a strong comeback, with the S&P 500 up more than 1.5%. Nvidia surged 13% following a positive analyst call. The world's most valuable company added a record $329 billion in value, shattering the single-day record it had set several times in the previous months. Treasury yields fell across the curve, and the dollar weakened against the developed market peers. Powell stated that the Fed could start rate cuts as soon as September. His comments came after the FOMC decided to keep the federal funds rate unchanged at 5.25 to 5.5%, where it has been since last July. Policymakers also made several changes to the language in a statement issued following their two-day meeting. Notably, the committee shifted to stating that it is attentive to the risks of both sides of the mandate, as opposed to the previous language that focused solely on inflation risks. The NASDAQ 100 gained 3%. The gauge of Mag 7 mega caps rose 3.5%. The $22 billion VanEck Semiconductor Exchange Traded Fund, SMH, rose 7.6% today, and the Russell 2000 index of smaller businesses rose 0.5%. Treasury 10-year yields fell 8 basis points to 4.06%. Oil rose after Hamas claimed that Israel assassinated its political leader, escalating geopolitical tensions. The yen strengthened as the Bank of Japan raised interest rates and announced plans to reduce bond purchases.
She will remain in her role until its successor is appointed, this according to the company release. All right, we're going to stick with earnings for you. We're going to break down all of them. We got Qualcomm, eBay, Carvana. We'll delve deeper next. This is The Close on Bloomberg.
morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
DOJ or other authorities.
Could face bigger challenges next.
Fed was going to keep rain World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Jobs Day, and Bloomberg has the report under surveillance.
Do you think the jury's still out on the strength of the labor market?
Well, part of the problem is that July is usually a very bad month for jobless claims accuracy.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
We see the jobless numbers climb just bit by bit by bit. Is this a welcome cooling or an unwelcome deterioration?
The July Jobs Report, Friday on Bloomberg.
A wave of earnings coming out after the closing bell. Let's get to a roundup of some of those notable movers. Want to bring in Bloomberg's Bailey Lipschultz, Isabel Lee, and Alexander Semenova. Bailey, let's start with you on Qualcomm.
Yeah, Alex, who says you have to be focused on AI to have fun in the chip space? Qualcomm up more than 6% post-market, beating expectations, driven by a lot of demand for smartphones. Stock was up more than 8% on the day, given that kind of rush back into semiconductors names. Want to call out their strong third quarter revenue guidance, expecting between $9.5 and $10.3 billion, above the midpoint what Wall Street was looking for at $9.7 billion. Also saying profit will be between $2.45 and $2.65 a share. Street had been penciling in $2.45, so well above what Wall Street was looking for. Another big print, though, from the semiconductor space in the wake of AMD. Going to be interesting to see if this follows through tomorrow. Isabel, what's going on with retail?
I'm looking at eBay. We have the company reporting adjusted EPS from continuing operations that beat estimate. You see the stock higher by around 1.7%. The number came in at $1.18, so that's higher year over year and higher than the $1.13 estimates. It's also a beat across the board. Net revenue came in higher, as did active buyers. We also have gross merchandise volume coming in higher than expected. So the reason why I think we're not seeing a bigger pop is really the third quarter revenue estimate. So the company reported a $2.5 billion to $2.56 billion, so that's a range. And the estimate is right smack in between, around $2 billion. 2.54 billion. All the numbers are confusing me, but it's just within the range. As for quarterly dividends, eBay maintained that its regularly quarterly cash dividend is at 27 cents per share, and the dividend declaration date is July 31. Stock is still up at around 1.6%, but year to date, it's up 26%. What do you got, Alex?
Hey, Isabella, I'm looking at used car retailer Carvana. Yes, that is the maker of those massive car vending machines. The stock is up about 11% here. That is after the company reported revenue and vehicle sales that beat Wall Street estimates, also reporting a surprise profit. Net income in the period was $48 million. That handily topped analyst estimates for a loss of $16 million. Carvana, of course, has been on a tear since late last year after a turnaround in its business where it cut costs and reduced some of its debt. It was battered back in 2022 during the post-COVID rout as higher interest rates shunned some buyers out of the used car market. But since then, it has returned to being a profitable leader in the industry. In fact, analysts at BTIG called Carvana's margins industry leading. It has reported gains after 6 of its last 8 earnings reports, including the last 2 where it rose more than 30% each time. The stock was up about 152% this year going into this report. Still, though, not a lot of love from Wall Street. The stock has 6 buy ratings, 14 holds, and 3 sells. It's going to be interesting to see how this move holds up tomorrow. Guys?
Well, who needs a buy rating when you got a 150% rally in 6 months? Our thanks there to Alexandra Semenova, Isabel Lee, as well as Bailey Lipschultz. A nice roundup of some of the earnings here in after-hours trading. We should point out Carvana, at least among the mid to large caps, the biggest mover in after-hours trading, up 10%. And I'm still astonished at just how much this stock has rebounded. I know it's nowhere near its old highs, but when you consider it dropped 99% and the fact that it's rallied, almost 200%
It's
off
a
those
massive
lows.
roller coaster ride. I know that you were recently in the market for a car. Did you go to a vending machine to get a car?
Yeah, I was a little disappointed. There was no vending machine. I bought a new car, so I don't know. Maybe they don't do that with a new car. A new car, they just jack you for as much money as they can and then push you out the door.
True.
But I have to say, it was kind of interesting to see too the lack of inventory on the lot, and I don't know if this is just indicative of that particular dealership, but it was still pretty sparse. Not quite as bad as what you saw if you went to a dealership in 2021 or 2020, but it was certainly still sparse.
You know where you could probably get a car? Tesla. You could probably get a Tesla. They're not going to have any inventory issues on that one. I mean, you can make an argument that it's the EVs that are plethora at the dealers if you need
that was the other thing, too. You didn't see a whole lot of EV or even hybrids, other things.
Yeah,
I mean,
definitely
a lot
not
of
hybrids.
ICE vehicles were available if you want them.
No, the hybrids are hard to find, but you can also go to like Hertz or Avis selling off their used EVs as well.
They're still like almost 30 grand.
I know.
I mean, at best, you get like maybe 19
for used
21 for a used Tesla. Yeah.
Which is actually enticing some people. I mean, considering some of those were like 50, 60 grand brand new.
I suppose, yeah.
All right, coming up, we're going to dive a little bit deeper into those earnings out of Meta. Stick with us. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Results coming out of Meta Platforms here. Better than expected sales in the most recent quarter. That ad business still the juggernaut that it's always been. Some concerns, though, about CapEx spending. CapEx spending that's going to hold, at least in 2024, at current levels. 2025, though, the company's saying it will continue to go up as it pushes deeper into the AI space. Kurt Wagner joining us right now, who follows this company for us here at Bloomberg News. And Kurt, let's start off first with the CapEx side of this, because I think a lot of people were wringing their hands coming into this report. I think they got some good news that the spend, at least for right now, isn't going any higher than where it's been, though they did kind of intimate here that 2025, it will go up.
Yeah, I think the story with Meta right now is just simply the balance between investing in this long-term AI stuff, both with LLMs and other, chatbots, things like that, and also the metaverse, and staying focused on, the core money-making business, right, which is the advertising business for Facebook and Instagram. And so I think that is the tension, as you point out. They've said, hey, in 2025, we are going to increase that spend. It shouldn't really be a surprise to people. Mark Zuckerberg has been saying this publicly pretty much every time he goes out and speaks these days. But I think, getting that confirmation from the company, knowing that they are going to continue to invest billions of dollars in this space is giving some people some pause.
But, they narrowed the range that they're going to spend on CapEx for 2024 to $37 billion to $40 billion. Were you surprised that it wasn't more? Like, was there a whisper number out there? Because it does seem like there's a relief that we didn't go over that $40 billion.
I wasn't surprised only because they had just raised the top half of that range to $40 billion at the end of the last quarter, and they did get a lot of pushback from that. If you recall, the stock had a really tough day. And so I think, they probably got some idea that, hey, that's the top of the range that the street's going to be happy with. Now, the fact that they've said, again, 2025 is going to be much bigger, they haven't given a range yet for that. That will be interesting when they do, because, again, I think there's a little bit of concern that Mark Zuckerberg, especially with the metaverse, is just really spending, some people think a little too aggressively in that direction. So once we get the range for 2025, I think that's when you're going to see some more movement there.
What does Meta have to show for the metaverse right now? Does it do anything? Is there anything happening on the metaverse?
The metaverse is not really giving them much except for stuff to talk about, right? A hope for the future or a goal for the future. I think AI more generally has given them stuff today. Their ads business is largely more concentrated. It's more targeted because of the AI that they have. The feed is more personalized because of the AI that they have. But I think the metaverse and this idea of, putting on glasses or goggles and sort of going into a virtual world, that is still so new. There doesn't seem to be any real, immediate impact on the business there, other than it's losing them a lot of money today.
Yeah, absolutely. I think in the neighborhood of $4 billion, as the last results show. Kurt Wagner, thank you so much. Kurt Wagner covers the social media companies for us here at Bloomberg News. Let's get more analysis now on Meta and its advertising business and bring in Mark Douglas. He is the founder and CEO of Mountain. So, Mark, we know that Meta has this large language model called Llama. It's open source. Technically, theoretically, it's supposed to help its advertising business. How do you see this working? Or is it actually something that Meta doesn't really need?
Well, there are two things that Meta is doing with AI. So one is focused on continuing to drive performance for their advertisers, the 10 million companies that advertise on Meta, and that can benefit from AI. And the other thing is increasing engagement on Instagram and their other platforms, Facebook and the other platforms. For the advertising biz, I actually don't think there's a lot of room for them to get better. They are incredibly good at using data to drive revenue for their customers. And I don't think people quite realize how good they are. If you take branded search out of Google's business, Meta is roughly not far behind Google in size, advertising revenue, and they don't have keywords to use. So, I mean, they're driving all of that just off of data and doing an incredibly good job of it. So I think people should, investors should be wary that there's going to be some massive increase in advertising revenue because AI, because I think Meta's already at the top of the scale there.
Are you surprised, actually, that they haven't made more of a push into some type of, a more developed search engine?
Not for Meta. I mean, people don't want to go to Meta for search. When you're in the mood to shop, you don't think, let me go to Instagram. And so what you do is you discover products on Instagram that Meta has figured out might be of interest to you using all sorts of other data other than search. So I don't see Meta ever really trying to challenge Google in search. I mean, in theory, with AI, maybe they try to make that move, but then they're also competing with OpenAI and Microsoft. I think where they're at right now, they have a really strong position.
I gotta be honest, I actually do go to Instagram to buy makeup. I'm just gonna put that out there because they have the cool stuff in the reels. I'm just saying. So if you're skeptical that their advertising is going to be able to get more out of AI because their advertising is already really good, how else then can they use AI to either increase ad spend, get more money out of each ad?
Right. So the real thing is, can they increase engagement? to continue to stay ahead of TikTok and get basically more hours in Instagram, and who knows what apps are available in the future. I think there's a lot more room for them to grow. The problem there is product market fit. Like, you can come out with a bunch of AI features, but people have to actually like them and use them. And it's product market fit, and that's not easy. That's not in the background driving ads. That's in the foreground getting people to respond. So I think they'll just keep iterating, and I think they will be successful there, but it's going to take a bit of time. And increasing engagement on Instagram will increase revenue.
I'm sure you've been watching the Olympics, Mark, and there have been a lot of commercials from Google advertising Gemini, its AI model, during, in between competitions. Are they doing a good job making a case for why consumers should be engaging with this function, or is it still kind of leaving people bewildered a little bit?
Well, I think obviously they've stumbled during the launch of Gemini. I mean, a massive stumble. Stumble's an understatement. But ultimately it is Google, and so much of Google's position is just that you have muscle memory to go to Google.
Yeah.
So but they have to back it up, right? Like, it actually has to work, and it has to be a benefit before maybe Microsoft or ChatGPT and other platforms start to catch up. So I'm not surprised at how much they're advertising Gemini, but I don't think they have an advantage at this point. I think people just see AI as new, and they see as ChatGPT and maybe Microsoft with that partnership as kind of being leaders there, and people tend to want to go for the leaders.
And it'll be interesting too to see how much we see this mashup between AI and search. Mark, though, I do want to sort of pick your brain here, your advertising brain specifically, and push ahead, because we are going to get some earnings over the next couple days from Apple and Amazon, two, I don't know if you call them major streamers, but certainly major companies that have really been trying to make inroads in that space here. When you look at those streaming services, the ad strategy that they've taken, both on the Amazon and Apple here, what improvements do you think they could make that would maybe make it more palatable to investors?
Yeah, well, I think Amazon's on a different level, because Amazon is is way ahead of the rest of the streaming industry in not only having a brand advertising business, but bringing their performance advertisers over from the Amazon homepage. So the Amazon homepage is search advertising. You enter what you're looking to buy, and then it not only shows you products, it shows you sponsored ads for often the same products or other products. And they're bringing those advertisers over into television. It's pretty similar to what Mountain's doing in terms of performance advertising. I think that's just giving them incredible advantage. And you can see it play out in that they flipped their entire customer base over to ad-supported in one day, and no one else has been brave enough to do that. And that's because they were very confident in their ability to monetize it. So they're just way ahead in the ability to do it, monetize it, grow it, and things like that. I think Apple has always been cautious about advertising, and that cautiousness is going to have them lag behind.
How important do you think that ads are going to become to Amazon, considering that it really is still just an e-commerce company with the cloud, which I get?
Yeah, I mean, I think it's going to be a massive profit driver for them. People, I still don't think people think of Prime as the first place they want to go for streaming, which is why, the likely reason Amazon has been heavily investing in sports programming and other programming that starts to get that into your mind. But it's going to be it's a hugely profitable business from everything anyone can tell for search, going to Amazon and entering what you want to shop for and having search ads. And I expect the same with streaming. And the person running that, the team running that, they're incredibly sharp. They built both of those businesses from scratch and done a really, really good job doing it.
Mark Douglas, founder and CEO of Mountain, thank you so much, giving his thoughts on Meta as well as Amazon and Apple, which will be reporting in the coming days. As we've been talking about, a lot of earnings coming out today, and we're looking at the move in after-hours trading. You could see Qualcomm there holding on to a gain of 6.4%, and that again is after its sales beat suggests the return of smartphones. People clearly liking what they're hearing from this chip maker on a day when chip makers gained overall. But Carvana, the standout here, gaining 10% on the day, turning a surprise profit as a used vehicle sales company.
Yeah, looking at eBay though, those quarterly sales and profit did exceed analyst estimates. However, the stock is still down in pre-market, in post-market, I should say.
All right, a lot moving here. MGM as well here. Interesting story on Aurora Innovation to keep an eye on that, and record profits over at Pilgrim's Pride. A lot of movers here in after hours trading that could really shape the tone for the cash session in the morning. Stick with us. A lot more coverage coming up here on the close. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching